NBA-ICLE training. Today, we're going to continue the tax training that we started yesterday. The first session for today is going to be taken by Mr. Stephen Arubike, who is a partner at GLIS. He's going to conclude where he started out from yesterday. So what will happen is we'll just allow just 1 minute for us to get to a certain number, and then Steve will start. The rundown for today's program is Mr. Steve will talk about transaction taxes. Then Mr. Bidemi Olumide will talk about other state taxes. Then we will have employment taxes explained. And then Mr. Jerome will talk, Dr. Jerome will talk about dispute resolution, taxes, and the tax tribunal. So at this point, I'm going to hand over to Mr. Stephen Arubike to start the session. And sorry, just before we start, if you have any questions during the session, please put them into the Q&A box, and we will respond to them during a break during this session. Thank you. Mr. Arubike, over to you, please.
Good afternoon, everybody. So like Ntaj mentioned, we are going to continue from where we stopped yesterday. And we have taken a look at some actual taxes, basically income taxes. And today we are going to look at transaction taxes. Looking at the subject, you see that we have withholding tax, value-added tax, hotel consumption tax, capital gain tax, stamp duties, electronic money transaction levy, Nigeria content development levy, and cabotage surcharge. So transaction taxes are basically the taxes that you meet in the course of a transaction, be it asset sale, loan transaction, and so on and so forth. Some of the taxes that we are going to discuss here, apply almost across board, while some are, sector specific. So we're going to start with the popular one that you might have encountered in the course of your work as a lawyer, that is withholding tax. The way I would like to handle withholding tax is also to draw a distinction sometime along the line with value-added tax. So I may be mentioning VAT, because sometimes it's confusing. People don't really appreciate the difference between withholding tax and the value-added tax. So withholding tax was actually introduced in Nigeria in 1977, basically as a revenue collection mechanism. It is not a separate tax, as you can see. It's just merely an advance payment of income tax. So it's basically deducted by a transaction party, and then on a fee or income the other party is entitled to, and then remitted to government. So in essence, a withholding tax could either be fall under personal income tax or companies income tax, depending on who will suffer the burden of tax. But one thing you need to know is that because, like I say, withholding tax is not a separate tax. You don't deduct it from income that is not liable to tax, and you also don't deduct it from in respect of payment to an entity if that entity is not liable to tax. We have discussed yesterday some of the entities that may not be liable to income tax, like approved charitable organization and so on and so forth. So in essence, if there's a payment, if the payment from one party to the other is meant for such entity, you cannot deduct withholding tax, because if you do so, you are like indirectly forcing them or compelling them to pay income tax. And you also have mentioned income that will not be liable to tax, so you don't also deduct withholding taxes from there. So you can see all the persons that are required by law to withhold tax and remit to government. So looking at the objectives of withholding tax, it may even help you to appreciate why government want to impose withholding tax. As you are aware, our income taxes, mostly personal company income tax is assessed at the preceding year basis. In essence, you pay your income tax after the end of the year, in the transaction or you earn the income. The government don't want to wait until the end of the year in some cases to collect the revenue, because of course the revenue is due maybe sometime within the year as you are earning income. So they introduce withholding tax in order to ensure that they collect the revenue as you go basis. That is actually withholding. That's what withholding tax is all about. So another important aspect of withholding tax is that sometimes you may find out that a non-resident entity, a foreigner, has earned income in Nigeria. And because the foreigner may not have fixed base in Nigeria, it will be difficult to compel that foreign entity to pay tax in Nigeria. So what the law requires is for the transaction party in Nigeria, before making payment to the foreigner, to withhold tax and remit it to the government. Because that foreign entity may not be able to, if the entity has no fixed base in Nigeria, it will not be able to pay tax, it will not be liable to pay tax, or even if it will be difficult for the tax authority to go after such an entity. And as a matter of law, such withholding, when you withhold against a non-resident entity, it is always a final tax. So because as I've mentioned earlier on, withholding tax is not a separate tax. So there is actually no distinct statute for withholding tax, other than the normal income taxes acts and the regulation that you have, like CETA section 78 to 84, PITA 69 to 75, PPTA, that petroleum profit tax act sections 56 to 54. So so these are the statute that creates the first withholding tax, the first class of withholding tax that we have. That's interest, dividend, rent, and royalties. But subsequently, government enacted the withholding tax regulation, making it virtually all form of transaction to imposing obligation on transaction party to withhold taxes. In almost all forms of a transaction. And you are going to see in the table the type of payment type or you are going to see class of withholding tax and the rate that a party is supposed to withhold and remit to government. So I'm not going to speak more about it. The table is there, and if you have any questions, you can ask. Now, when are you supposed to file withholding tax returns? It depends on whether the entity suffering the withholding is a company or an individual. In case of a company, we have 21 days to after the duty to deduct arose for the company, for the entity to withhold and also to file a return, to file tax return to the government. In case of an individual, the time to file return is 30 days after the duty to withhold. There are penalties for failure to withhold, even though you are not the one. The person that is actually withholding and remitting is acting as an agent of the tax authority, and the entity that is suffering the withholding is at the other side of the spectrum. Yet, if the entity that's supposed to withhold fail to withhold or has withheld but failed to remit, there are penalties under the law for such infraction, and I mentioned them in the slide. And one thing about withholding tax is the credit note system, and it is very, very important. And this is where people are not usually aware that there is such a system, because they think withholding tax is just once you pay your withholding tax, that's the end. No, I mentioned tax credit yesterday. So here, look at how withholding tax credit works. When the best entity that have withheld and remitted to government after withholding, supposed to get a credit, both a receipt and a credit note. And the credit note is not meant for the agent that has withheld. It is meant for the other party who has suffered the burden of the withholding. So you're supposed to send the credit note to that entity, so that at the end of the year, when that entity or an individual is to account for income tax, either personal income tax in the case of an individual, or company's income tax in the case of a company, the credit note will serve as a tax credit to reduce the income tax payable by that entity. As you can see, the withholding tax credit note will reduce if you have suffered if your income has suffered tax under withholding tax system, you have a credit note to reduce your tax to the extent that have been withheld. So there are some contentious issues surrounding withholding tax that I just want to mention in passing. Now, if you are involved in financial transaction or some other transaction, you might have heard about the tax gross up clause, where you say the payment due to A to B shall be net of all taxes, levies, and withholding. What are we talking about here? Withholding tax is this is a case where the party who's supposed to suffer withholding tax have passed the burden to the other party in the transaction spectrum. Is it legal or not legal? In Total and Akinpelu, the court held that withholding tax regarding leases, where the leaser, between leaser and leaser, if there's a withholding a tax gross up clause that is legal, though some people have been disputing that regarding the withholding tax regulation, but I don't see any issue here. It is contractual. The essence is to ensure that the revenue has collected its share of tax. So it is a contractual arrangement between parties on who will pay that tax. I mean, that is purely contractual and is legal. So there's also the issue on sales in ordinary course of business. If you look at the table this table, you're going to see that the last item is contract other than sales in the ordinary course of business. There have been an issue on what constitutes sales in the ordinary course of business. FIS has been interpreting this to mean that whenever there is a well-drawn agreement regarding sale or a transaction, that it cannot come under sales in the ordinary course of business. But the court says, the courts have held otherwise in Tetra Pak, West Africa, and FRS. Here, the court has set out a criteria in determining whether the transaction or the contract constitutes sales in the ordinary course of business. What the court is saying that it is not just it doesn't mean that when there is an agreement or a contract that it no longer constitutes sales in the ordinary course of business. The court will look at the memorandum of the association of the part or the entity that will suffer the withholding, and also whether the sale is in the ordinary course of business. That is whether it is what that party has been doing or have been doing habitually. If it is something in the ordinary course of business of that entity, it will constitute sales in the ordinary course of business. And I think this decision is sound, because you can't just say because I have a contract regarding my operation, it will no longer constitute sales in the ordinary course of business. You have to look at the business of the entity involved and to see whether it is in its ordinary course of business. So we are going to move into value-added tax, and here there is always a confusion whenever both withholding tax and value-added tax, whenever a transaction is liable to both withholding tax and value-added tax. But let's look at it this way. In the case of value-added tax, well, let me just go to introduction first, and then I will draw the distinction and also, try to highlight to show how you can identify value-added tax and withholding tax. So VAT is a consumption tax, while withholding tax is an aspect of income tax. So they are not the same. While VAT is an indirect tax, withholding tax is a direct tax and it's a tax on income. So here we are talking about consumption tax, a tax that you pay for consuming goods or services, while on the other side we are talking about a tax that you pay for earning income. So that's one distinction. So for VAT, VAT is the burden of VAT is on the final consumer, but the collection process is at each stage of the production and distribution chain. Now, what do I mean by that? I will explain this further when we go into output and the input VAT. And of course, you are aware that there have been an increase in the VAT rate from 5% to 7.5%. And in some countries, VAT is known as goods and services or GST tax. Where VAT is no longer new in Nigeria, but before VAT, we have what we call sales tax. The difference is that in the case of sales tax, you charge it at the end. You charge the sales tax at the on the final consumer, so you don't charge it. You don't charge it at each stage of the production or distribution value chain as VAT. Now, there's also a modification in VAT. The entity that's supposed to file returns or comply with VAT, there have been an adjustment, providing that if the entity has a supply below 25 million naira, it has no obligation to register or to be filing VAT return in that case. So we also have another tax that is another consumption tax in operation in some states, hotel occupancy and restaurant, hotel occupancy, restaurant and entertainment taxes, and we are going to look at it later. It's similar to VAT, but it's purely sales tax because it is charged at the end. It is charged to the end users, unlike VAT that is charged at each stage of the production or distribution. Now, let's go into the mechanism. Now, like I mentioned before, you charge VAT at each stage of the production or distribution process. Now, how do you charge this, or how does it work? Now, the first thing I'm going to do is to explain what we mean by input VAT and the output VAT. Input VAT is a tax that you have. It is a tax that is included in the price of a product that you purchase. If you are involved in, let's say, production of goods and services and you bought raw material, the VAT that you are paying on the raw material to you is an input VAT. It is paid on the supplies that you have received from a supplier. So let's just look at it this way. The manufacturer purchase raw material. The VAT that is paying on the raw material is input VAT. But after after manufacturing, and the manufacturer, of course, have to sell the product to either a distributor or to the final consumer, and there will be a VAT on that product. So that VAT that same manufacturer is charging on the product that he is selling to either a distributor or to the final consumer is called output VAT. Now, the actual VAT that the manufacturer will be liable to account is the difference between output VAT and the input VAT. And from our explanation here, it will naturally follow, but not always the case, that output VAT will always be higher than input VAT. So the difference is the VAT that the manufacturer will be liable to pay. And of course, the person that will bear the eventual burden is still the final consumer. But in a case where there is where the input VAT is higher than the output VAT, there will be eligibility to claim a VAT refund. And of course, it's an administrative process. So there are some goods or services that are zero rated. Those items are liable to VAT, but at a 0% rate. So if you have if the VAT is zero rated, you don't pay. You don't reclaim. If you say a zero rated this thing, you don't claim reclaim. You can reclaim input VAT on purchase that relate to those products, and there are some of the products have been mentioned here. Then we have those that are outrightly exempt from VAT, and I listed some of the products or some of the goods and services that are VAT exempt in this slide. You're going to see some of them. Now, one thing that you also have to realize that exported goods are zero rated. That if you are exporting, you don't need to pay VAT on export. Rather, you pay VAT on imported goods or services. I'm still going to explain some of the controversy relating to VAT on exported and imported services. Well, filing of VAT, how do you account for your VAT return? 30 days, you file you file also on a preceding month basis. That's after the end of the month, you file your VAT return for what transpired or the VAT that you have collected before that month. I've mentioned the increased rate. You don't need to go into it. I've also mentioned the compliance threshold. Services by a foreign provider. Well, that's a controversy that has, bothered Nigerian court for some time, and it was finally resolved by the amendment in the Finance Act. Previously, it was because of the way the VAT Act was, the provision was couched. It's not clear whether you can charge, whether you can actually charge VAT on imported services. It's not very clear, unlike that of goods and services. So the controversy raised, and there are decisions in Vodcom Business Limited and FRS, and also Gazprom. The two cases, the court confirmed that imported where a non-resident entity render services to a Nigerian resident, there will be a VAT. But the problem here is that who will account for the VAT? That takes us to what we call the reverse charge mechanism. Reverse charge mechanism is where you reverse the order of the person that's supposed to account for the VAT. Now, it is no longer the service provider that will account for it, because of course, in case of imported services, the service provider will naturally be outside Nigeria. So there's a reverse in that mechanism, and the recipient of the services in Nigeria is supposed to account for that VAT. And of course, as I mentioned earlier, it is actually that entity that will suffer the VAT. So he's supposed to take it from his own pocket and comply or remit to government. Now, there's a provision under the Finance Act 2019, making reverse charge mechanism to apply across the board. That means if the entity, that's the service provider, whether in Nigeria or outside Nigeria, has failed to charge VAT on his or his invoice, the beneficiary of that service, the beneficiary of the goods or services in Nigeria supposed to comply. So in essence, they are now two-pronged approach to VAT compliance. It could either be the service provider, it could be the service provider, it could also be the consumer of the goods or services. So what it means that if the service provider has failed to include VAT on the invoice to the consumer or the consumer has the obligation to comply with VAT remittance. So there's also an issue on when taxable services has taken place. If you look at section 40 of Finance Act 2020, there's a provision that tries to create a controversy on whether a Nigerian service provider, whether there will be VAT when a Nigerian entity or an individual in Nigeria is providing services to a person outside Nigeria. There won't be VAT on that, because if you look at the VAT Act clearly, exported services are clearly exempt from VAT. So notwithstanding that provision in section 40, my view is that all exported services are clearly captured in section 46 and the first schedule to VAT Act clearly exempt all exported services. So notwithstanding the amendment in the Finance Act, exported services will not be liable to VAT in Nigeria. It is actually the other country and the spectrum that's supposed to start VAT, because here we apply what we call destination principle when it comes to VAT compliance in cross-border transaction. There's also a raging controversy regarding the legality of VAT, and that has been there for a while, but the court has not made a final decision on the issue, and we have been seeing cases in favor and cases against, especially a case that was decided last year. I'm going to mention it when we move into hotel levy. So hotel consumption law or hotel consumption levy. Now, the several states have been making an attempt to impose sales tax regarding consumption that are taking place in a hotel. An example is Lagos State. So we have Lagos State on June 22, 2009. Lagos State enacted its own hotel consumption law, imposing 5% tax on consideration paid for goods and services consumed in a hotel, restaurant, or event center. And like I mentioned earlier on, there have been controversy regarding this tax. Can you charge consumption tax twice regarding particular services? So most hotels have sued the government for interpretation on this point. And they have, like I said, they have in earlier case on this point that says that VAT Act has covered the field and you cannot charge consumption tax again. But a decision last year, hotel owners and AG of Lagos actually invalidate VAT. Invalidate VAT and pronounce or affirm the legality of the Lagos State consumption law. But that case is a decision of an inferior court of a lower court. So it cannot override the decision of the Supreme Court on this issue. So I don't know whether there's an appeal. So the issue on sales tax on the hotel consumption law vis-a-vis VAT, to me, is a political issue. And I don't know whether the court will be so confident enough to pronounce on that, because some people are with the view that because the Constitution did not confer power on the National Assembly to make law regarding sales and VAT. The laws, the National Assembly is limited when it comes to tax, has limited power to make tax only on income, capital gains, stamp duties, and so on, but not on consumption taxes. So some are of the view that the state has the residual power to make law on that. But from the standpoint of a tax payer, I don't think it's good to allow to give the state such latitude to make to have such power to make law on taxes. I mean, you may have a state increasing the rates. You may have one state imposing tax on transactions that took place across the border. But we are yet to see finality on the point. Even in the case of NECA and the AGF regarding the validity of Kano State consumption tax, the court held that such tax is illegal. So we have the tax for the Lagos State consumption tax is, you can see the tax base. The tax base, I've listed the tax base. That's an item on which the tax is imposed on. Then you have seen the taxpayer. The taxpayer is the consumer, but it is not actually the consumer that remits and files the tax return. It is actually the hotel's owner who is acting as the collecting agent for the state. So most of the provisions that you see in a typical tax legislation, you see it also in the Lagos State consumption tax regarding rate, collecting agent administration, duty to register, reporting period, and so on and so forth. They also have the right to impose a best of judgment assessment where the hotel owner or the collecting agent failed to file tax return regarding the transaction. I'm trying to be fast to cover this within the time. There's also notice of appeal. But where I have issue with the enforcement procedure, enforcement process of the Lagos State consumption tax is the 7 days upon which you must contest an assessment before it becomes final and conclusive. I think the time is too short, but let's see. But that's the law. You have to try and comply within time. And if you can't comply within time, you have a right to also seek extension of time. And of course, naturally, the High Court of Lagos State has the jurisdiction to determine or to entertain issues regarding the Lagos State consumption tax. So let's quickly move to capital gain tax. Well, capital gain tax is a tax that is imposed on the realized gain from disposal or exchange of some certain kind of asset. That is a tax that will always be imposed when you dispose, sell, when you have disposed, sold, or exchanged some asset, and the rate is 10%. So the chargeable asset, all forms of property, including incorporeal property. Somebody asked that question, whether right under intellectual property is chargeable, whether capital gain tax is imposed on. So yes, it falls under incorporeal property. Capital gain tax will be charged on disposal or exchange of intellectual property. In fact, even right under a contract, if you have sold your right under a contract, you're supposed to pay capital gain on it if there is a realized gain, or there are realized gain on such a disposal. However, you don't impose capital gain tax on stock in trade or an asset that habitually you are offered for sale. Even a property, let me give a typical example of a property dealer, somebody whose business is to buy and sell property. That is like his goods, the land, the leases, and the land or property that he has, his stock in trade, his goods. He will buy and sell property. So you don't charge capital gain tax on such operation. Rather, what the person will pay at the end of the year is income tax. And I think it's not really better for a real estate dealer, because income tax rate, of course, is higher than capital gains, the rate of capital gains tax. So it's better for him to even pay capital gain tax than income tax, because income tax rate is, of course, is higher. Well, disposal of asset outside Nigeria. If you are in Nigeria and you dispose of your asset outside Nigeria, and you brought in the proceeds in Nigeria, you also have to account for capital gain tax. And even if you are a foreigner and you are in Nigeria for up to 180 days and you dispose an asset outside Nigeria, you may be liable to also pay capital gain tax. Now, authorities that for enforcement of capital gain tax, we have both the state internal revenue services, service for various states, and the FRS. For when it relates to individual disposal, a disposal between two individuals, then the state authority. When it relates to a disposal between companies, two companies, or between a company and an individual, the jurisdiction falls under that of the Federal Inland Revenue Services. We have some recent development regarding capital gain tax, appointment of agents. This regarding disposal of the recent amendment in the Finance Act, where there is where you are paid compensation for loss of office or employment. The Finance Act 2020, impose an agency relationship on the person who is paying the other party such compensation for loss of office to withhold the capital gain tax that is due on such disposal, and then remit it to government. And you're also meant to file your returns at when due. Then I will take you to some of the exemptions under capital gain tax. I've classified them under those applicable to securities, gain on disposal of stock, shares, other government security, treasury bill, bonds, savings certificates are exempted from capital gains tax. We also have disposal relating to not-for-profit entities, government entities, merger and acquisition. Of course, there's a catch under merger and acquisition. You see that where there is a major acquisition or restructuring, you have to fulfill some condition. One of the conditions that have been imposed under the Finance Act is that within a year, the entity that is to merge, you have to satisfy that condition under Section 49 of Finance Act for you to enjoy that exemption. We also have services, some personal services. These are all exemptions under under capital gains tax. We are going to move quickly to stamp duties stamp duties. Because of time, I think I have about 15 minutes left. Stamp duties are chargeable on specified documents or instruments. It's also chargeable on instruments executed outside Nigeria when they are brought into Nigeria. I've also mentioned here the time that you are supposed to account or pay for stamp duties. And you can also see here that the Finance Act 2019 now impose a stamp duty on document executed electronically. We have under stamp duties rate, we have the flat rate and we have the ad valorem rate. The flat rate is just flat, while ad valorem rate is based on the value of the property. And if you look at the stamp duties schedule, the schedule to the stamp duties that it specifies several rates. Sometimes it's really difficult to understand the schedule itself because stamp duties that we are applying in Nigeria is actually a legislation enacted by the colonial government, and some of the transactions that we have today are not clearly captured in that schedule. So sometimes it is not very clear on whether a particular some transactions are liable to stamp duties. So there's also penalty for failure to pay stamp duties. I've mentioned that. Now, why do you need to pay stamp duties? First, if you fail to pay stamp a particular document, such document may not be admissible in evidence for any purpose under the Stamp Duties Act. Failure to stamp also affect the ranking or the priority of a security or collateral instrument. So you need to stamp early and register if you fail to stamp, of course, naturally, if you want to present the document in the public registry for registration, they will not accept it. So if you have not stamped, you have not perfect, and if you have failed to perfect, and when it comes to ranking or priority, the transaction or the instrument, security instrument created further to that document will not rank prior to even a later one if that document was stamped earlier. So it is always good to stamp. That's why in a finance transaction where there is a collateral security, there is always an obligation to stamp, and the bank must insist that you stamp such a document. There are also some exemptions, documents that are exempted from stamp duties, instruments for scheme of arrangement or amalgamation of companies. If you look at the conditions under Stamp Duties Act, it's a mistake, I've corrected before sending out the slide. Also, transfer from self to self. If you transfer a document to yourself, it will not be liable to stamp duties. Also, in relation to an account held by one person, it won't be liable to stamp duties. Withdrawal from savings account and salaries are also not liable to stamp duties. We have some controversies under Stamp Duties Act, and I think in a way it's been resolved. There have been controversy on whether NIPOs can increase stamp duty rates for adhesive stamp. NIPOs and MBs, they could say no. Then we have the case of a Standard Bank and Nigerian Limited and CASMA, where that's an old case. It's been overtaken by the Stamp Duty Survey. Then that was when the first attempt to stamp bank transfers and bank deposits was made. CBN simply sent out circulars to bank and asked them to start deducting stamp duty on the bank deposit and the money transfer, and the banks sued. And the court held that there's no authority on the CBN governor to impose or increase stamp duties rate. But the authority come up with an amendment of the Finance Act, now making it legal. And that goes back to what I mentioned yesterday, that the power to tax must come from the parliament. Where we also have the case of a joint tax board attempting to amend Stamp Duties Act by putting a rate not different from what is in the Stamp Duties schedule, and it's not legal. But somehow we've not seen a case challenging that for the court to make a pronouncement on it. Sometimes you see FRS trying to recharacterize instruments. It is not also legal. We need court decision on that. Whether each transaction are liable to stamping, yes, yeah. Look at section 2, section, look at the Finance Act, which have amended section 2 and section 58 of the Stamp Duties Act. I will quickly, just mention electronic money transfer because it's more or less like an aspect of a Stamp Duties Act. If you look at the current Finance Act 2020, section 48, impose 50 naira one-off duty or levy on electronic transfer. So that's it. You have to pay, but it's now a one-off provision, but it is limited to a deposit or transfer of up to 10,000 naira and above. Well, I've mentioned the history regarding attempt to tax fund transfer and deposit before. Then we are going to look at another transaction type that is specific to oil and gas industry, the Nigerian Oil and Gas Industry Content Development Act. Well, this Act, what we call, what we always mention as a local content act, imposes a payment of 1% on Nigerian content development levy. The levy is payable on every contract awarded to an operator, contractor, subcontractor, or a partner in relation to operation in the upstream oil and gas sector. There is also a board that manages the levy. There have been issues regarding this levy because sometimes the board have been imposing the levy on contract not related to upstream oil and gas sector. And sometimes they've also been imposing it on a contract between a local operator and a foreign operator, but there's no judicial decision regarding the imposition of this levy. Another sector-specific transaction tax is the cabotage surcharge. Well, you might have those who are in shipping operation must be quite familiar with the Coastal and Inland Shipping Cabotage Act 2003, which we call Cabotage Act. It also established a tax relating to a transaction in that sector. The Act established a cabotage vessel financing fund, the cabotage fund. And how to finance the fund? There's a surcharge of 2% on contract, relating to a vessel engaged in inland commerce or inland trading. So the essence is to raise funds to fund local shipping operation. So there's no indication regarding the deductibility or otherwise of that recharge. That is whether a company that have paid such a levy or surcharge will deduct the payment from its income tax in its income tax calculation. I've been so brief to enable us complete this, and I will share the slide and also a link to an article I wrote on VAT issues in the Finance Act 2019. I'm able to entertain one or two questions before the other facilitator come on board.
Hi, Steve. Thank you very much for keeping to the time. Thank you. So we're just going to take a few questions for 10 minutes. So the first question is from Judith. Please, I was not clear on the decision of the court on the legality of putting in the contract that the contract value contract sum value is net of all taxes, shifting the duty to pay the relevant tax on the other party, especially on leases and deed of assignment.
For leases is valid. The case I mentioned, let me go back to that area. The case I mentioned here, Total and Akin Pelu, the court says the court held that it's valid that what we call tax gross up clause is valid. That is the decision in that case, and I think the decision is rational. That's right. The court decision, the only court decision I know of, Total and Akinpelu, you can read that case in 2004 17 Nigerian Military Law Report, Part 903. The court held that it's valid in relation to lease. But for other, I think the similar, following from that decision, we can assume that it's valid. But people have been raising issues that there's a particular clause in the withholding tax regulation that, that try to create the impression that it's not valid. I don't think that is the case. It's valid because it is purely a contractual matter. If I have a payment obligation to government and I agree with a contract party that contract party will pay, will discharge that obligation, there's no I don't see why it's not valid. And besides, there's no provision in the act or in the regulation expressly prohibiting such a clause. And remember, tax clauses are interpreted, or tax provisions are interpreted strictly. So if there's no provision in the act clearly making it invalid or prohibiting such use of such clause, I don't think I'm of the view that is valid. And looking at the case of Total and Akinpelu, I think the court decision there is that such clause is valid.
Okay, so Ambrose is asking, could you elaborate on the point that relates to your reservation on the state's consumption laws? You voiced the concern that the state could impose the consumption tax arbitrarily.
I didn't say so. My view is that if you look at the Constitution clearly, it is not clear whether the National Assembly can impose taxes outside income, stamp duties, and capital gain. So if we have such express provision both in the exclusive legislative list and the concurrent legislative list, we also assume that since we don't have sales or consumption tax there, that it's a residual matters for the state. So that's why the state has been taking steps to impose a consumption or sales tax in the name of a hotel. But currently it is limited to hotel consumption. And the finality of that, there is no finality on the issue. And the decision has been contradictory. Like I say, if you read the AG Lagos and the Eco Hotel, I think in that particular case, the court said expressly that the VAT Act has already covered the field. But in a case decided last year, hotel owners case, the hotel owner that sued AG Lagos State, the court held that hotel consumption tax is legal, and the court even went ahead to declare VAT Act invalid. But it is a decision of a lower court. So my view that is this is a purely political issue, and the finality of that, we still await the finality on that point. Okay. But they will always be attempted by the state to collect as much tax as they will. But from the standpoint of a taxpayer, I think we should stick to what we have. Because if we allow state to arbitrarily impose taxes, I mean, it's not the best for us. But when you look at the Constitution clearly, if you ask me, if you look at the Constitution clearly, I think the state can tax outside income, capital gain, and stamp duties. But like I say, opinion is divided on that point. I don't know your view.
Okay. All right. So Roland is asking, can you tell us the distinction between zero-rated goods and services and exempt goods and services in terms of accounting?
Okay. For zero-rated items, you reclaim input VAT on any payment or purchase. While on exempt goods, you don't do that. So that's basically the difference between the two. on whether you can reclaim impute VAT or not. I'm not an accountant. I don't know how we do it for accounting purposes, but from a legal standpoint, that is all I can say. Whether or not you can claim impute VAT. And like I said, like I mentioned earlier on, so you can claim impute, you can reclaim impute VAT on any purchase on zero-rated item, but you cannot for items that are clearly VAT exempt.
Okay, so Aki is asking, it appears...
Look at my slide very well. In this particular case, I mentioned you don't charge any, you don't claim impute VAT. Yes, let's go to Akin's question.
So Akin says it appears FIRS only works to get money to government, covers in that there are many exceptions to all tax regimes that are not harnessed for taxpayers so that they can pay less. How acceptable,
Go ahead.
acceptable to FIRS or SIRB itself personal assessment for the purposes of payment?
It's the last sentence. Say it again, please.
It says how acceptable to FIRS or he wrote SIRB.
State Inland Revenue Board, I guess.
State Inland Revenue Board, yeah. Okay.
Okay. Is self or personal assessment for the purposes of payment.
How acceptable?
Yes.
That question is not very clear. Well, there are several exemptions.
Accessible.
How
It's not clear. It's not a clear question, even from my end.
Yeah.
It's not clear.
Actually, if you can retype your question, that'll be helpful for us.
Yes, retype it, and if I get clarity on it, I can answer it and post it in the question and answer section. Yeah, question and answer part. Okay,
so please throw more light on debts as taxable under capital gain tax.
Well, debt is an asset. It's as simple as that. And it is even if you look at section 3, debt is an asset. If I extend if a bank has extended a loan to a customer, you can sell that debt. It's an asset. It's an incorporeal asset. So on that standpoint, if you look at stamp duties, it clearly stated that debt is a chargeable asset under the stamp duties tax. It is not a tangible asset. You know, we have tangible and intangible assets. So debt is chargeable to tax under the stamp duties under the capital gain tax. I think the question related to capital gain tax.
Yeah, capital gain tax. Yeah.
It's a chargeable asset. Look at section 3. It's very, very clear. It's explicit in that section. Debt, option, and so on and so forth. Even options are chargeable. If you sell up, if I decide, if for instance I gave a loan to A, or company A gave a loan to company B and disposed that loan and made chargeable gain, it's subject to capital gain tax. It's there black and white. But maybe you may not understand the concept. A banker will always understand this clearly because, of course, we have been seeing banks selling loan to AMCON or selling loan to discount houses. If the entity selling the loan had made realized gain on the sale, it will be levied. Capital gain tax will be paid. Of course, if you don't pay capital gain tax on it, you are going to pay income tax. So it is even better for the seller to pay capital gain tax at 10% instead of paying company's income tax on the realized gain as an income tax at 32%. That's 30 plus 2.
Okay, so we got these questions a lot yesterday. Is an arbitrator's fee subject to withholding tax? If yes, why? If no, why? Please.
Arbitrators' fees. Well, I think if you look at, let's go back to our schedule. Arbitrators' tax can fall under any of the services. It's not certain.
Professional services, not.
Yeah, exactly. Yes, it's under professional services, or we can. call it consultancy. It's purely professional. It's purely. Obidemi, you want to say something?
I know I was just trying to throw a banter that Steve hesitated a lot there because it was going to affect his own
I guess
fees.
Say what?
Okay, so they're saying that you hesitated because it's actually a question we kept having. You know, you hesitated before saying it. Are you an arbitrator?
No.
It's certainly affecting Stephen's
I
fees.
think you see, arbitrator is a lawyer.
Yes.
Or in most cases, arbitrator could be a lawyer, or but of course you can. It is you can call it professional. It will be under professional services, yes, or because I can call it a consultancy. It's not under consultancy, so I think it's a professional service. Well, I'm also an arbitrator. We offer arbitration services. And I think we're paying.
Okay, just before I introduce,
you see, the problem is that the government eye is always on withholding tax. If at the end of the day I've paid my income tax fully, why will you come back and start claiming withholding tax? Because the component of income tax. So I think the government is diverting attention. If somebody has accounted for his income tax fully, why will you still bring up the issue on whether my fees have suffered withholding tax or not? I think it's not really proper. But we have to take this in court. Because if the person that's supposed to suffer the burden of withholding tax, at the end of it, I mean, I've declared and accounted for my tax fully. Why are you still going back to the tax that you're supposed to collect earlier on? The most important thing is that you have paid your tax in full. I mean, we should be bold enough to challenge this. The most important thing that I've fully accounted for my income and I've paid tax. Because withholding tax is not really a separate tax.
Okay, so the next speaker is Bidemi Olumide. He's going to talk on other state taxes. And so please, Steve and Folajimi, please, if you could just go through the question and answer and just give live responses to them, well, so that when we come back for question and answers, you know, you must have given most of the responses. So just go through the chat box.
Yeah, thanks. I've been doing that. I think I've answered a couple already.
Yeah, you've answered
continue.
6. Yeah, so Bidemi, if you are ready, please over to you now to continue on other state taxes. Then after that, Folajimi is going to talk about employment taxes. Then Jerome is going to start talk about dispute resolution, and then Folajimi will conclude for us. Please, Bidemi, over to you now.
All right, thank you again, Intel. Taking on other states and local government taxes, I promise you this will be very quick. So we start with state taxes. I'm very sure when Dr. Jude introduced the topic, introduced the sessions yesterday, he had mentioned about the federalist system of our tax, the federalist structure of our tax system. So each of the federating units each of the 3 federating units in the country certainly have the jurisdiction in terms of the administration of taxes. And if you recollect, when I spoke on income taxes, I said that the jurisdiction to legislate on income taxes is exclusively that of the federal government. However, the collection and administration of the tax is with the state government. But that's aside, the laws like the approved taxes and levies collection list, provides exclusive jurisdiction, some jurisdiction to states. At the last count, we could itemize about 9 heads of taxes that the states can collect. Ditto also the local governments. So for states, let's start with them. One that is very topical apart from the consumption tax that Steve had elaborately spoken about is a property tax known as the land use charge. we see states. And one other thing to find about state taxes and local government taxes is the advancement that you see, particularly as it relates to state governments being a little bit much more, progressive. So you find some state governments a bit much more progressive in their internal revenue generation more than others. I think what we currently have here is a broad spectrum of lawyers all across the federation. So if you have a state where, revenue generation is probably at a low ebb, it creates a fantastic opportunity for you to look at the laws that are available in that state and probably speak to your state government or whatsoever as to what it can do to ramp up its revenue collection. So land use charge for states that have, of course, all states have land, all states have property sector, if there's anything so-called. So what you find out is a lot of states are happy on this. Of course, the foremost state in terms of land use administration, land use charge administration, is still Lagos State, and Lagos State currently has some much more detailed land use charge administration process. Its most recent land use charge law was in 2018, where it revised the rates that are applicable, the land use charge rate. So on my slide, you see the segmentation of the distribution. So you have owner-occupied premises, you have industrial premises, you have residential property, that's the owner not occupying it. You have commercial property, and you also have vacant property and open and empty land. So you're not only paying a land use charge because you're using the land, but you also pay land use charge if you leave the property also unattended to. And you can see that the rates between whether it's unoccupied and whether it's vacant and empty are similar, and they are similar, whereas you have increased rates when it comes to industrial property or property where the owner is not occupying or is using for commercial purposes. And who is liable to land use charge? It's in this space that you find a lot of some tax skimming. So typically, if you are going to be going for a long lease under Lagos State tax law, if you are an occupier, you're going for a long lease that's different from an owner, you'll be held responsible for the land use charge. Otherwise, the land use charge is the responsibility of the owner. We do contractually. Some decide to contract that responsibility to the tenants, which at least on the authority of Total and Akinpelu that Steve has spoken about, you can contract out your tax obligation. When we say you contract it out, in other words, you can shift the tax burden contractually. But then when the tax authority, of course, comes, it comes to the person that the tax is statutorily laid on. So yes, you have to respond to the tax authority, but subsequently, on the basis of whatever contract you might sign, you might proceed against your counterparty for the obligation that they have freely and voluntarily entered into. So the property land use charges on owners, but then occupiers, especially where the occupier is taking on a long lease that's 10 years and above, the responsibility is statutorily laid on them. You also see on my slide there the penalties for the penalty for not complying with the laws, in terms of the payment of land use charge. What are exempted, properties of religious organizations, public cemeteries and burial grounds, and as well as the royal institutions, especially the palaces of the Obas in Lagos. I'm sorry that like I said earlier, I'm particular about the state that has the law. In this case, I kind of focus much more on the land use charge law of Lagos State. Other sources of revenue of state governments include, not on this slide, of course, like I mentioned yesterday, the revenues from employees. That's the payee, the pay-as-you-earn tax that goes to the state government. Also, withholding tax on individuals, the capital gains tax that is payable by individuals, stamp duties on instruments executed by individuals. And in recent times, a lot of states have now, one state in particular that is doing some phenomenal job in the taxation. We call it gaming taxes. Is Edo State. Edo State is doing taking some great stride in the taxation of the gaming space. So you find them taxing pools and betting activities, lotteries, and the same in casino taxes. Business premises registration fees are also, I expect for urban areas, more times than not in cosmopolitan states or societies like Lagos, almost all business premises registration fee is also earned by the state government. It's a flat 10,000 naira for your very first payment and 5,000 naira for subsequent payments. So, and then, like I said earlier, consumption taxes. Thanks to Justice, the states might thank Justice Aikawa of the Federal High Court in its decision in the Attorney General of the Federation and Attorney General of Lagos State, and the restaurant owners that Steve had spoken about, where just like how I said that the VAT Act, to the extent that it seeks to the VAT Act, to the extent that it seeks to tax consumptions of in hotels and the restaurants, it has overgone its bounds, because the jurisdiction for the taxing of such commercial activities is that of the state. Relying on the schedule to the Constitution. So I think that decision in itself has further spiked a lot of interest in other states now to revamp their hotel consumption or similar consumption tax laws for transactions that have happened within the territory of their state. But then that also has some significance in terms of how it is dealt with administratively, because you cannot exempt yourself from VAT. In other words, you decide that the FRS is not going to collect VAT from the territory, and then at the same time try to share from the revenues of the VAT. Revenues gotten from VAT that applies to other territories. So typically what might happen in this case is that for states that are taking themselves out of the VAT pool, then you're not going to be sharing from the VAT proceeds as it's currently shared and pursuant to the VAT Act in itself. So quickly we move to the local government taxes. The third tier of government, the closest to the citizenry, the closest to citizens. In time past, the taxes collected by local governments have significantly been neglected, but in recent times, and also again, I'm very quick to point out a state like Lagos State. You've seen Lagos State make a lot of stride in terms of the tax administration at the local government level. The popular case on this is the Etiosa local government and Jegede, which, to an extent, it could be said that probably are working local governments to the fact that their bylaws or to the laws as to what is to be collected in terms of taxes needs to be a little bit much more certain. But what Lagos State had done, seeing the number of local governments, I think currently Lagos State has about 20 federally recognized local governments and 37 LCDAs. What it's done is to try to administer or try to organize the local government such that the rates that are collected from local government to local government is a bit fairly certain. Some public notices, which you see later in the slide, has been provided as to what each local government can collect on each head of tax. At the last count, local governments, for example, in Lagos State, could collect as much as taxes on about 16 heads of taxes. That's a very big pot, particularly if it is well administered. And some local governments, for example, the Yaba local government in Lagos State, and maybe the Lagos Island local government have gone a big step in terms of ramping up their IGR purposes. One major one that provides them some significant revenues are the radio and TV licenses. It's always a top earner for local government. Yes, we still have a law that surcharges both businesses and individuals, at least, who have any of this, the radio and TV in their premises to a fee known as the RTV, or the radio and TV license. And the rates, ranges from as low as 100 naira to 1,005 for individuals, from 5,000 naira to 200,000 naira for corporates, for businesses. Other heads of taxes that local governments could levy on is the open market levy. Yes, we could say it's 50 naira daily, but then where local governments have gone ahead to automate these processes, it's been a significant windfall for them, because some of the challenges you have with local government tax administration is the issues around revenue leakage because of the crude way in which it's collected. But then where you see local governments like Yaba, like I mentioned earlier, automating the processes with the infusion of POS terminals, the usage of USSD channels for payments, and the likes. You see them now, account and going to the bank smiling because the monies are percolating in quicker torrents. Other heads of taxes are liquor license fees, parking fees, and the rest that is mentioned on the slide. So with that, so what I've done here, what you find on this slide is an extract from how Lagos State government are tried to, you see this on this slide and the next slide, how Lagos State government are tried to organize the local government revenue collection system. So you have local governments differentiated on how urbanized they are, from the most urbanized, which is listed as category A plus, to A to B, and lastly to C. You see the difference in their rates. You also see the way they decided to dimension the sizes of business. Again, you have to look at the numbers. By the time you look at the numbers in terms of the population in the local government, and then you times some of these figures by then when there is sorry, Steve, maybe you can mute your system a bit, Steve.
I'm coming, okay.
All right then. So by the time you see the numbers and then you multiply them by the number of residents or the number of businesses in the local government, you can as well guess what is coming in to the local government in terms of revenue. So the rest of the slide provides the number. So with that, I think I come to the end of the presentation and I'm able to take questions. Okay.
All right, thank you. Thank you, Bidemi. Just because we don't have time now, I'm just going to move to Jerome, Dr. Jerome, to start his presentation. And if you'd be so kind enough to just look through the Q&A box. Falajimi has also been answering the questions, so we could just go through questions so that we can generally just take everyone's presentation within the allocated time. So I'll just hand over to Dr. Jerome Okoro, who is going to take us through dispute resolution. Please, Dr. Okoro, please go ahead. Hello, are you there?
Yes, I'm trying to bring up my
Okay.
to bring up my slides now.
Okay.
Just a minute.
Okay, just while you're doing that, I will just quickly say that Dr. Okoro is the managing partner at Tetralex Legal and Advisory. I hope I got that right.
Yes, you got it right.
Okay, so we're waiting for you to start.
Just a minute. I had an issue with
Okay, so while we're waiting for you, the last speaker will be Folajimi Akin. Sorry, just bear with me. Akinla, he's the senior manager at PwC. Dr. Jeremy, you're ready for us now, right? Almost.
yes. Okay, I don't know if the screen is on now.
I can actually see your screen. I can see your screen. So yes, so you can go ahead.
Okay. All right, thank you. So the screen is on now. Okay, thank you very much.
Can you increase your volume, please?
Okay.
All right, thank you.
Is it better now? Is the volume better now?
Yes, please. Please go ahead.
All right, thank you very much. I will be taking the topic resolving tax disputes in Nigeria, and is divided into three parts. We see the introductory part of it, of course, the root of disputes in tax, which is self-assessment, demand notices, and then tax objection and the notice of refusal to amend. That's the NORA. Before we now go into the core aspect of dispute resolution, the process of dispute resolution in the tax appeal tribunal and the appellate courts to which the appeals from the tribunal proceed. So I start with self-assessment and demand notice. By way of introduction, the filing of returns and payment of tax as and when due is the simplest method of avoiding dispute, because the disputes arise when these compliance requirements are not they are not adhered to. When the taxpayer does not compute or properly compute his tax or its tax, and provide the records to the tax authority in order to determine the accuracy of the tax paid, and then the tax authority is compelled to conduct its own exercise, as raise its own assessment, administrative assessment, and then enforce the tax, and then there is a contention or disagreement with the taxpayer, then the dispute arises. So if a self-assessment is adhered to, the payment of tax and then the filing of returns is adhered to, then there'll be a minimal dispute in tax. So talking about self-assessment, we know about tax assessment, but self-assessment, as the name implies, entails the taxpayer computing and correctly as well computing the tax liability for the relevant period, paying the assessed tax, and then filing the returns together with the evidence of payment. It is a policy. It's in line with the voluntary compliance policy of taxation in Nigeria. In other words, you are doing the tax assessment yourself, you are paying the tax, you are only submitting the evidence, the record of the tax showing its accuracy, and the evidence of the payment to the tax authority. This started in 2011 under the Tax Administration Self-Assessment Regulations 2011. It was gazetted in 2011. But whereas this regulation was introduced by the Federal Inland Revenue Service, it applies to the taxes, which are accruable also to the state governments, like personal income tax, and then aspects of capital gains tax, and withholding tax, and even stamp duty. They are also accrued to the state government, much as they do to the Federal Inland Revenue Service, representing the federal government as the federal tax agency. Now, the taxes to which the self-assessment regime relates, the regulation itself lists a number of tax laws to which the regulation relates. You have the Companies Income Tax Act, the Tertiary Education Trust Fund Act, which is the enabling law for education tax, the Petroleum Profit Tax Act, and Value Added Tax Act. But by the omnibus provision in Regulation 2, sub 3 of the regulations, one can say that the self-assessment regulation applies to all tax laws, rules, and regulations in Nigeria, because it covers the laws, the tax laws, rules, and regulations in the Federal Inland Revenue Service Establishment Act 2007, and the first schedule to that FIRS Act lists almost all the tax laws in Nigeria, and the ones not listed, the Regulation 2.1 of the self-assessment regulation also provides for it by stating that it includes such other laws, rules, and regulations as may be enacted from time to time. So in respect of every tax, it is subject to the self-assessment regime, where the taxpayer would by itself compute its tax, pay the tax, and file the returns together with the evidence of payment. Now, naturally, there will be disputes between the provisions of the regulations and the enabling laws. It is easy to resolve. Of course, the enabling laws being substantive laws as against the regulation, which is a subsidiary legislation. Those laws will prevail because there are areas of, there are provisions, maybe for the timeline of the filing of the returns, the penalty or the interest provided, even though substantially the regulation adopts the provisions of the specific laws in terms of the time of compliance and the penalties or the interest for non-compliance. But where for any reason at all conflict is detected, then one will have to adhere to the provision of the specific law in respect of that task in order to determine the compliance requirements relating to that task. Of course, the Federal Inland Revenue Service Establishment Act overrides because in itself, it makes some provisions that will apply to all the taxes subject to the Act. That's that are listed in the first schedule to the Act. For instance, it makes a general provision in its section 32 in respect of penalty. That's a penalty, a general provision of 10% penalty for failure to comply with self-assessment and payment of tax. Now, it is very controversial what I'm saying now about the overriding status of the Federal Inland Revenue Service Establishment Act 2007. But look at if you look at section 68, subsection 2 of the FIRS Act, it makes the FIRS Act supreme to every other law. I would say that apart from the Constitution of the Federal Republic of Nigeria 1999, any other law that comes into conflict with the FIRS Act will bow and give way to the FIRS Act. That is the language of section 68, subsection 2 of the FIRS Act. In compliance with the self-assessment regime, the taxpayer has the right to file the return, the self-assessment return, disclosing a payment in person, or can use an agent. But as lawyers now who would want to broaden the horizon, to widen the ambit of their tax practice beyond dispute resolution, litigation in the tax appeal tribunal and in the courts, to now include compliance, rendering compliance services to taxpayers, filing returns, you have to go beyond your qualification as a lawyer, being called to bar and paying your practice fee. The self-assessment regulation requires that acting as an agent, as a professional agent to a taxpayer in filing self-assessment return, you have to be an accredited member of those three institutions, those three organizations listed there. That is ANAN, the Association of National Accountants of Nigeria, Chartered Institute of Taxation of Nigeria, and Institute of Chartered Accountants. You have to go extra miles to gain the membership and also be accredited in order to render the service of tax filing for taxpayers with the tax authorities. But it is noteworthy that when an agent is filing return for a taxpayer, when the taxpayer is not filing returns in person, the forms that go with the returns, the self-assessment forms and the returns must be signed by the taxpayer personally. And if it is a company, the form must be signed by a director of the company or the company secretary. The due dates for filing returns, we'll have to gloss over this because in the course of the other lectures by, I'm sure Steve in the course of his presentations and Bidemi and the other ones, they have mentioned the due dates for compliance in terms of filing returns. And we say that the filing of returns that is as provided, the timeline for filing of returns and payment of taxes as provided for in the specific clause. But to make a gloss over it, PIT is on the 31st of March. Personal income tax for the self-employed. If it is payee for employment, the employer files the returns and pays the tax on the 10th day of the subsequent month. In other words, the self-assessment compliance for the month of March 2021 is the 10th day of April 2021. But for the self-employed who is paying personal income tax, it is the 31st, in respect of the year ended on the 31st of December 2020, it is the 31st day of March 2021. For CIT, for old companies, 6 months after the end of the accounting year. The accounting year is different from the tax year. The accounting year ends on the 31st of December of that particular year of business. But then the year of assessment, that's the year, the timeline for the due date for self-assessment in respect of a company is 6 months of the year after the accounting year. In other words, for the year ended 31st of December 2020, the due date for filing for compliance is June, the last day of June 2021. That is for an old company, an existing company. But if it is a new company, then it is 18 months after the 18 months after the incorporation, or 6 months at the, after the end of the accounting year, depending on whichever comes earlier. It is noteworthy that based on the provision of Section 55 of the Companies Income Tax Act, every company in Nigeria, whether or not exempted from tax payment, must file returns. It is mandatory for every company. So if you have, if you are exempted under Section 23 of the Companies Income Tax Act, or you are under the threshold, the 25 million gross annual, the gross annual income threshold that pays zero companies income tax tax to Federal Inland Revenue Service, you are still mandated to file returns. So exemption from tax payment does not ipso facto exempt you from filing of returns. In fact, it's the returns that will determine whether you fall within that threshold of tax exemption under the Finance Act. The contents of returns, we'll have to talk about that of a company, is essentially the audited financial statement that a company is filing in its returns. But the contents of the audited financial statement will be filed is a computation of capital allowance, the schedule of fixed assets. In respect of fixed assets, in order for it to be allowed by the Federal Inland Revenue Service and for you to claim allowance on the fixed assets, the extra requirement there is to obtain certificate of acquisition of a fixed asset, CAFA, which is issued by the Industrial Inspectorate Division of the Federal Ministry of Trade and Industry. Also contained in the returns is a statement in writing of the amount of profit from each and every source. All the sources, the profit from all the sources must be represented in the returns. And then the self-assessment fund, of course, as I said earlier, the company or the secretary, the company director or company secretary will have to sign the forms, even if a professional is being used. PPT is on estimated basis. There is the final PPT, which the PPT is paid on installments. Then the timeline is stated there for PPT. And for VAT, Steve has spoken much about compliance for VAT. Then interest and penalty, the consequence of non-compliance is the payment of the tax that is due. Tax is imposed by law, you cannot escape it. But if you don't pay when the law requires you to, you are paying something added to the substantive tax, which is interest and penalty. The various tax laws, they provide different penalties, but Section 32 of FIRS Act makes a general provision. I've said that earlier, and interest on CBN minimum rediscount rate. Now, interest and penalty, when will it start running? This is very, very controversial because in computing tax assessment, in assessing taxpayers to tax, even if it is best of judgment at assessment or additional assessment when the tax authority feels that the tax earlier assessed and paid is not accurate, that it should be more. They add the interest and penalty, and taxpayers challenge this, that the provision of Section 32 of FIRS Act presupposes that the tax must be certain, it must be final and conclusive, it must be due for payment before interest and penalty can be deemed to have arisen when it is not paid. So if that construction of Section 32 is the case, then if a tax assessment is challenged within the time of objection to the tax assessment or is appealed against to the tax appeal tribunal or the court or any other court having jurisdiction, then interest and penalty ought not to have arisen. And the tribunal has told the line of this reasoning in the case of Weatherford Service and FIRS and Tetra Pak, where they held that actually the tax must be final, the tax assessment must be final and conclusive. Final and conclusive meaning not subject to any objection by the taxpayer or litigation, that's appeal from the taxpayer for interest or penalty to arise. Though there are conflicting decisions on that, but one judgment, I think, involving Shell and Lagos Inland Revenue Service, the reason of the tribunal is that the personal, the pay as you earn, payee liability there is not the liability of Shell itself, but the tax liability of its employees. So if the liability is to deduct from payment from earnings of your workers and remit, then this issue of final and conclusive will not arise because the liability is not your own liability. That's a conflicting reasoning in one case involving a Shell and Lagos Revenue Service. Objection and notice of a refusal to amend. This is the second part of the topic. When assessment is raised, of course, the tax authorities, they raise assessment, they serve the assessment on the taxpayer. Then expected of the taxpayer is either to comply with the assessment without dispute, or the taxpayer has a right. In fact, the law mandates the tax authority that in serving the assessment, remind the taxpayer of his right or its right to object to the assessment pursuant to the provisions of the tax laws. So when the assessment is served, the taxpayer can object to the assessment. The foundation of assessment is failure to file self-assessed assessment returns and pay the tax. So in the absence of voluntary compliance, the tax authority now resists the assessment. And then if the returns is filed, but the tax authority feels that it's not adequate or accurate, then administrative assessment comes on. So administrative assessment is as a consequence of failure to file self-assessment. Now, the administrative assessment can be by way of best of judgment assessment or additional assessment. Best of judgment if there is no returns. In other words, there is no guide to the tax authority. Additional assessment if the tax authority feels the tax already paid is not accurate. It should be more than that. Circumstances warranting best of judgment. When returns are filed, the tax authority can reject the returns, or if the returns are not filed or the taxable person is not within the tax net, that is when a best of judgment is raised. So there is no guide to the tax authority. But even as there is no guide in terms of returns, the Court of Appeal in the case of Nigerian breweries and Lagos Internal Revenue Board still held that even in BOJ, it should be reasonable, it should be fair. So it should not be dishonest or vindictive or capricious. In practice, what the tax authorities do is if there was a year or a previous year that the taxpayer has filed returns, they take a guide from that or they assess the business of the taxpayer. Now, additional assessment. The controversial issue in additional assessment is in terms of limitation period and assessment going beyond the limitation period. Limitation period for additional assessment is 6 years. All the enabling laws for the tax, for the income taxes like the Personal Income Tax Act and the CITA and PPTA, they give a period of 6 years to the tax authority to raise additional assessments where they have a basis to feel that tax was not paid or tax was not paid in full. Now, if the non-payment of tax, non-assessment of tax or under-assessment of tax resulted from any form of fraud or willful default or neglect, please note that the default or neglect must be very, very willful. So there's inadvertence that may not qualify for this willful default in order to warrant additional assessment beyond the 6 years. So if any of these three grounds is the reason for non-assessment or under-assessment, then the additional assessment will be indefinite. The period is indefinite, it's not within the 6 years. Now, audit and tax investigation still relates to this limitation period. Routine audit is the exercise of the tax authority confirming the returns and records of the taxpayer in order to ascertain the actual tax to be paid or to confirm that the tax as paid was accurate. But if the tax authority suspects that fraud or willful default or neglect, as I stated earlier, has been committed, then they carry out investigation. The difference between audit and investigation, in my own opinion, the investigation which is geared towards the discovery of fraud or willful default or neglect, the law says where fraud, willful default or neglect has been committed, it is like a quasi-criminal inquiry, and by the provision for fair hearing under Section 36 of the 1999 Constitution, if you are examining somebody, if you are probing somebody in order to make discovery of a criminal act or omission, then the provisions of fair hearing must be adhered to. So a situation where the tax authority will just raise an assessment and say this assessment is based on our suspicion that you have committed a fraud or you are guilty of a willful default or neglect will not stand. Otherwise, that provision will be abused. I think the ideal thing, if it must adhere to fair hearing, is to raise the specific allegation against the taxpayer and require the taxpayer to present a defense to that allegation before the assessment arising from that allegation can be made, because the basis of that assessment is that fraud, willful default, or neglect has been committed. That's the language of Section 55 of the Personal Income Tax Act and the other equivalent provisions like Section 36 of the PPTA. So what they say is the act has been committed, not that you suspect that it has been committed. So if it has been committed, then there has to be fair hearing. Objection to assessment, as I said, the objection can be raised by the taxpayer. And the objection, what is required is the objection must be in writing. In writing does not mean it has to be hard copy, because in Earth Moving International Limited and FIRS, the tribunal recognized email bearing the objection. So if if the objection is communicated to the tax authority through email, then it suffices. The objection has to state the grounds of fact and law for which the taxpayer is convinced that this assessment is not accurate or this assessment should not be in the first place. There is a 30 days time limit to raise objection from the time of the assessment. That is for CITA and PITA, but for petroleum profit tax is 21 days from the time of the assessment. Then notice of refusal. When assessment is served, the tax authority has the option of either amending the assessment or discharging it outright or refusing to amend it. But if he chooses the last, which is refusing to amend it, he has to issue NORA. But none of the laws make a provision for the time limit for issuance of NORA. That of objection is 30 days from the time of the assessment. But notice of refusal to amend by the tax authority, there is no time limit. And this has also raised a controversy. Does it mean that the taxpayer will have to wait indefinitely? What if the tax authority comes with enforcement to levy the strength or goes to seal the business of the taxpayer? That the tribunal in Oando Trading and FRS says no, that the taxpayer has the option of either appealing or objecting. That when it objects, it should not wait indefinitely. If after a reasonable time, maybe 30 days, as in the case of objection, it feels like it can come up with its notice of appeal, that's with its suit against the tax assessment. Demand notice is raised when the assessment has become final and conclusive. As I said, that is when there is no objection or appeal, or when there is an objection but it has been resolved and there's agreement between the taxpayer and the tax authority on what should be paid from the assessment, or if there's an appeal, there is a final judgment on that appeal. In that case, the assessment has become final and conclusive, and that is when a demand notice is issued. But in the case of withholding tax, as Steve said in his presentation, withholding tax is not a distinct tax on its own. Withholding tax is a payment mechanism for income tax, advanced payment method for income tax. There is no assessment preceding demand notice. It's just demand notice at a go, because it is not the taxpayer that actually pays. It is the person paying the taxpayer his income that deducts and pays the withholding tax and gives a withholding tax credit note to the taxpayer from where he offsets his tax liability, income tax liability, when he eventually pays. You see those two decisions, Federal Inland Revenue Service and Gazeta, and MEDOS on when assessment has become final and conclusive. Now we come to the core part of dispute resolution, which is the proceedings before the Tax Appeal Tribunal and the appellate courts. Tax Appeal Tribunal, is it a court? This was a controversy that I myself have encountered in the course of my tax litigation. It is a tribunal established by law to resolve or adjudicate over tax disputes. It was established by the Federal Inland Revenue Service Establishment Act, Section 59, precisely, because the FIRS Act established the tax tribunal. It doesn't mean it's only federal taxes that fall under the jurisdiction of the Tax Appeal Tribunal. The 5th schedule to FIRS Act that created that confers jurisdiction on the Tax Appeal Tribunal, precisely paragraph 20, lists the various tax laws, and that includes the Personal Income Tax Act. So personal income tax or withholding tax or stamp duties or capital gains tax, which accrues to state governments, also comes under the jurisdiction of the Tax Appeal Tribunal. Proceeding before the Tax Appeal Tribunal is deemed to be a judicial proceeding, and the Tax Appeal Tribunal is deemed to be a court. That is the controversy. Is it a court? If it is a court, then is it not interfering with the exclusive jurisdiction of the Federal High Court under Section 251 of the 1999 Constitution. We'll get to that. What are the rules that govern the procedure of the Tax Appeal Tribunal? We have the Tax Appeal Tribunal Rules, 2010, that is the Rules of Proceedings. FIRS Act, the 5th Schedule to FIRS Act makes elaborate provision on proceedings. Then the Evidence Act that guides the admission or rejection, admissibility or rejection of evidence applies to the tribunal. You have locations where you find the tribunals there. Now, there may be an error in filing an appeal in one of these, whereas the taxpayer is in the tax assessment belongs to another division. It's not struck out, the appeal is not struck out, rather an application is made and is transferred to the right division where the proceedings continue. Now I have raised this issue, so what is the resolution? Before the TAT, there was the VAT Tribunal, Value Added Tax Tribunal. This same issue also confronted the VAT Tribunal. Did it have jurisdiction over VAT, which is a federal government revenue, considering the exclusive jurisdiction of the Federal High Court? And the Court of Appeal in Stabilini Visioni and FBIR, and also in the Cadbury case, held that the VAT Tribunal, the VAT Act, that's Section 20 of the VAT Act, which created the VAT Tribunal, was in conflict with Section 251 of the Constitution. And so it invalidated Section 20 of the VAT Act for that inconsistency. What was the reason behind this decision by the Court of Appeal? The reason was that Section 20 enabled appeals from the VAT Tribunal to proceed straight to the Court of Appeal. In other words, placing the VAT Tribunal in coordinate jurisdiction with the Federal High Court. So that drew the ire of Section 251 of the Constitution. But in the case of the Tax Appeal Tribunal as established by Section 59 of FIRS Act and the 5th Schedule to FIRS Act, the decisions of the tribunal are still subject to appeal to the Federal High Court. You don't appeal against the decision of the Tax Appeal Tribunal to the Court of Appeal. Rather, you appeal to the Federal High Court. And since the supervisory authority of the Federal High Court is still preserved over decisions of the tribunal, then Section 251 is not offended. So it allows the Tax Appeal Tribunal to stay. And this was confirmed or upheld by the Court of Appeal in the case of SINOC. They consolidated cases involving SINOC and the Federal Inland Revenue Service, that because of this appeal from Tax Tribunal to the Federal High Court, Section 251 is not offended. So it doesn't get angry against Section 59 of the FIRS Establishment Act, which created the Tax Appeal Tribunal, unlike Section 20 of the VAT Act. But in spite of this jurisdiction of the Tax Appeal Tribunal, this High Court, that's the Federal High Court and State High Court, still wield their original jurisdiction over taxes involving revenue of the federal government. That's Federal High Court in the case of taxes subject accruing to federal government, and State High Courts in the case of taxes accruing to state government. What are the circumstances? I have mentioned appellate jurisdiction of the Federal High Court in terms of a decisions of Tax Appeal Tribunal. Apart from this appellate jurisdiction, nothing has happened to the original jurisdiction of the Federal High Court in respect of tax disputes. So if the dispute is such that there is no contentious fact, no fact in contention, it's just essentially interpretation of a law, a regulation, or a contractual arrangement between parties that are subject to payment of tax, and it has to do with the tax. There is no factual controversy there. Then it is to go by way of originating summons to the High Court, either the Federal High Court or the State High Court, and let the Tax Appeal Tribunal be. So you still have the right, instead of going to put witnesses through the trial process that is required in the tax appeal tribunal, you raise and you sue by way of originating summons and let the Federal High Court or State High Court interpret the law and resolve the dispute. Now, time for commencement of the appeal is 30 days from the tax assessment, or if there is a NORA, if objection was raised and there is a NORA, then 30 days from that NORA, or if it is not an assessment, any other decision you can bring within 30 days of that decision. But there is a provision for extension of time. This is not a limitation statute provision where you say the right to sue or to appeal to TAT is statute barred. No, you can apply and have the time extended. What are the processes? The processes in the tax appeal tribunal is akin to proceedings by writ, that is trial by way of writ of summons in the High Court, even though the originating process is a notice of appeal. But notice of appeal is similar to writ of summons and statement of claim. It is the pleading. Notice of appeal is a pleading, but it has the form of a notice of appeal to an appellate court where you state the grievance in summary, what you're appealing against, being the tax assessment or the decision, and then you are stating the particulars, numbering the particulars stating the grounds, numbering the grounds of your appeal and attaching the particulars to each of the grounds. It's in the form of a notice of appeal. But with the facts you're stating in those particulars, it is the pleading. In other words, the statement of claim of the appellant. They are the plaintiff in the TAT is the appellant. Now, there is also front loading, in that attached to or filed together with the notice of appeal is the list of witnesses, the witness statement, the list of documents, and the documents to be relied on by the appellant. And in turn, the respondent files the respondent's reply, which is in place of the statement of defense. It's called the respondent's reply, and is also in the form of grounds of the reply and particulars, but it's stating the facts in the particulars. And also there's front loading of the respondent's witness and the documents to be relied on. And then in turn, the appellant files a rejoinder. Rejoinder is like a reply pleading. After the rejoinder, the pleadings will close. Anything coming after that will now come by way of amendment. That's amending the earlier processes filed. Right of representation. Here, unlike what we said about self-assessment, you as a lawyer, just by virtue of being a lawyer, you don't need any task specialization. You don't need to belong to any institution. You don't need anything further to your call to bar certificate and your payment of practicing fee and the stamp and seal. Of course, you need the stamp and seal in the processes in the tax tribunal, unless you are not filing your papers as a lawyer. So apart from your qualification as a lawyer, you don't need anything extra to represent a party at the tax appeal tribunal. A lawyer can represent as counsel to any of the parties, but apart from lawyers, chartered accountants are also allowed to stand in for parties, and tax advisors are allowed. But then if there is an appeal from that decision, the chartered accountant or the tax advisor who is not a lawyer cannot go beyond that, because it then becomes the regular court. Now, proceedings and application of evidence. It is controversial here, and one has to be very, very keen. You have to take utmost care in applying the rules of evidence. The rules of evidence apply to proceedings in the tax appeal tribunal. Section 256 of the Evidence Act exempts the following from application of rules of evidence. That is proceedings before an arbitrator, proceedings before a general court martial, and proceedings in certain customary courts or Sharia courts. But then the tax appeal tribunal is not among these ones that are exempted from application of rules of evidence. And the opening part of section 256 of the Evidence Act says that the Evidence Act is applicable to all judicial proceedings. And remember what we said about paragraph 20 of the fee schedule to FIRS Act, that the proceedings of the tax appeal tribunal is deemed to be judicial proceedings for all purposes, and the tax appeal tribunal is a court. So this being the case, one can now consider to mean that the Evidence Act is applicable because of section 256 of the Evidence Act is applicable to the Tax Appeal Tribunal. The inclination of the tribunal, however, is that it will relax the rules because it sees itself as only a fact-finding body in order not to jeopardize justice on the altar of procedural niceties. But then it's better to err on the part of caution so that you also have to consider that your case will go on appeal to regular courts, the Federal High Court, the Court of Appeal, and the Supreme Court. And if there is any breach of a rule of evidence that is fundamental to the decision of the tribunal, it may be revisited on appeal. So it's better to lay a very strong foundation before your appeal goes to those higher places. Then trial, of course, by way of the normal trial in regular courts for cases by writ, you put your witness, the appellant or the respondent will put the witness in the witness box, and then there will be examination in chief, cross-examination by the adverse parties counsel, and the re-examination, and then the particular party having that witness will close its case. At the end of the day, the last party to present evidence, just like as is done in trial by writ, will be the first party to file final address, and then the other party files a reply address, and then there is the reply on point of law, and then the tribunal gives its judgment. Now, I'm talking about, we'll go to appeals. I hope my time is still there for me to we'll go to appeals from TAT. Further appeals from decision of the Tax Appeal Tribunal proceed to the Federal High Court. And please note that even though, as I said, there are taxes that are accruable to state government, which are subject to the jurisdiction of the Tax Appeal Tribunal, the appeal from a decision of the Tax Appeal Tribunal on such a tax dispute like personal income tax accruable to a state government will still go to the Federal High Court, not to state High Court. An appeal from decision of the Tax Appeal Tribunal, even though it involves the revenue of a state government, must still go to the Federal High Court and not a state High Court. The proceedings of the Federal High Court in this appeal from the Tax Appeal Tribunal is governed by the Federal. Okay. Proceedings of the Federal High Court.
I think there is something that the CBN to encourage the bringing in of
proceedings of the Federal High Court in this appeal from the Tax Appeal Tribunal is governed by the Federal High Court Tax Appeal Rules 1992 and not Federal High Court Civil Procedure Rules. Even interlocutory applications like motion for stay of execution, like a motion in the course of that appeal to the Federal High Court from Tax Appeal Tribunal is still subject to the provisions of the Federal High Court Tax Appeal Rules 1992 and never the Federal High Court Civil Procedure Rules. And those provisions for late filing, penalty, as provided for in the Federal High Court Civil Procedure Rules, they do not apply to appeals coming from Tax Appeal Tribunal to the Federal High Court. And now note this controversial provision in the Federal High Court Act. Section 34 of the Federal High Court Act gives priority to cases involving revenue of the Federal High Court, of the federal government in the Federal High Court. Either that case is coming by way of an originated proceedings, as an originating proceedings or appellate proceeding from the Tax Appeal Tribunal, it still enjoys priority under Section 34 of the Federal High Court Act. Now, when this issue is raised, now I can draw the ire of a senior advocate, so one has to be very discreet in order to not to raise so much dust in praying a judge to call a case out of turn if it has to do with revenue of the federal government, but that is the provision of the law, is Section 34 of the Federal High Court Act. We did not make the law. Then further appeals from the decision of the Federal High Court will now proceed to the Court of Appeal. And when the Court of Appeal decides, ultimately, the Supreme Court decides, and after the Supreme Court, of course, it's Almighty God that can overturn the decision of the Supreme Court. I thank you all for listening. I thank you for the audience.
Thank you very much, Dr. Jerome. So we'll just go quickly to Folajimi. Please, Folajimi, if you're ready, since you're also going to be taking the second part of dispute resolution, please let's take yours so that we can take the questions together for 15 minutes. Folajimi, are you ready?
Okay. Yeah, that's fine. That's fine. Thank you very much.
Okay. And just before you start, Dr. Jerome, please, if you can look through the question and answer section and just go through any questions that relate to your part, we will appreciate it. Folajimi, please go ahead.
Yes, can you see my screen?
Yes, I can see your screen.
Yeah, good afternoon, everyone. My name is Folajimi Olamide Akinla. I'm a tax lawyer, senior manager, and I lead the tax controversy and dispute resolution team in PwC. Thanks, Jerome, for setting the tone for today's presentation. So my topic basically is other practical dispute resolution options. So we'll look at introduction briefly, types of dispute resolution options aside litigation, which includes domestic and international options. We'll look at the challenges specific to Nigeria, then conclusion and what next. Now, when I was preparing these slides, I came across this statement by a French philosopher. He says, avoid lawsuits beyond Yes, it says avoid lawsuits beyond, look, I can't see this because I'm sharing my screen, but they will impair your health. Who can agree with me? They would pervert your conscience. That means you lose the sense of what is right and wrong. They will impair your health. You have high blood pressure, palpitations, and dissipate your property. You will lose money, right? I don't know if that's true. If you agree with this statement, if you don't agree, but it's somebody's view of lawsuits. Now, I recall when I came out of law school, I was going to start work, and my father said to me, I want you to work in a firm where you will do serious litigation. Litigation is, according to him, the mother of all practice. If you do litigation, you would be able to do other practice areas easily. Well, I didn't know whether he was telling me the truth or not, but I listened to him. So I went to a law firm that was renowned for dispute resolution, particular litigation, Tayo Yotiba & Co., now Tayo Yotiba LLP. And I found out that, yes, he was partly right. I also found out that with litigation is characterized by serious delays, long delays, caused by congestion of the cost lists, which lead to unnecessary adjournments, and adjournments are caused by sometimes inefficiencies of our colleagues on the other side. I also found that litigation can damage relationships. It can lead to acrimony. It can lead to you having less than smooth relationships with your colleagues. I also found that litigation had extremes. In many cases, was winner takes all. So either you win if you have a good day in court, or you lose. So it seemed too extreme. And they are the costs. They're the costs of litigation, time, money, opportunity costs, etc. So in all the positive points of litigation, which Jerome has explained to us, I found that these were also realities of litigation. So then what are the options with respect to tax disputes? Now I realize that there are domestic options that are, or that relate specifically to different countries. Nigeria has FRS settlement meetings, which I'll speak on in more detail. And there are ad hoc meetings, other meetings will come up in the course of discussions with FRS or state revenue boards, and which come up in the course of audits. With respect to other options, which are majorly international, or which are options where you would easily apply in the case of cross-border or international tax. So we have APA, which are advanced pricing agreements. I'll speak on that. We have MAP, which is mutual agreement procedure, stroke arbitration. We have factual determinations, and mediation, which I'll speak on. So some of these options are mutually exclusive and some are complementary in that you can use them together. So what are the domestic options? What domestic options do we have? So we have the FIRS settlement meetings. So this was something majorly driven by FIRS sometime towards the close of 2019, where the government was hard pressed for cash. So government says, oh, instead of us having all these cases at the Tax Appeal Tribunal that could potentially go on appeal to the Federal High Courts and then Court of Appeal and ultimately Supreme Court, why don't we invite taxpayers and see how we can sort of settle? So it's an initiative that is driven by the office of the chairman of the FIRS. It's semi-formal. It's not really, I mean, you have directors from FIRS represented, you have the taxpayer side, and you have the tax legal team of the FIRS. So there are no formal rules of guidance, but then the taxpayer will make its representations, the FIRS makes their representations, then the panel of directors of the service would consider both options or both views. The idea is the panel is objective because one, they did not take part in the audit process and they don't take part in the litigation. So I've been in a couple of these meetings and I note that some of the discussions are technical, right? So we go into the merits of a dispute, what a dispute could be about, what are the strengths, what is the position of the law in this dispute. There are also non-technical discussions, e.g., you could get instances where revenue is telling you, oh, yeah, put something on the table. What do you have to offer? How can we settle this? So it's one of those things where the FIRS thought to give them quick cash because of the state of the economy without having to go through the whole hog of trial or litigation. Of course, it saves time and it saves money. Now, on the part of the taxpayers found it attractive as well because it saved precious time for businesses. Businesses also want to keep and maintain the relationship with FIRS. You know, the relationship with the business and FIRS is in many instances longer than marriages, because as long as a business is in existence, it will have an interaction with FIRS or with the tax revenue. So it was supposed to be a place where both parties are on the same plane. And the idea again is everybody wins. So there's no victor and no vanquished. In many of these meetings, the taxpayers settle, right? So the good thing is the taxpayer finds a way of paying an assessment, but not as high as the assessment that was initially assessed by FIRS. On FIRS part, FIRS gets cash early on. Of course, the cash is not what it will have gotten if it had won based on the assessment, but cash in hand is worth cash tomorrow. So that's basically the most formal dispute resolution option that we have. As I mentioned earlier, there are others. So in the course of audits, you would have invitations by FIRS or state inland revenue services for meetings to discuss the issues, the technical points. So those as well form part of the options taxpayers can consider. I remember a partner telling me once, he says to me, Falajimi, the fact that we end up in court in litigation means that we have lost. We have lost. And in his own mind, when a dispute degenerates to litigation, it means we have not served the client properly, because the objective for us would be to manage disputes so that they are resolved as quickly as possible. Because in most cases, when you get to litigation, it means you've tried everything before then and nothing has worked. So there's an emphasis on exploring these meetings, on these avenues before getting to litigation. These days, I tell my clients, we can litigate at the Tax Appeal Tribunal, but we'll always keep litigation as the last option. So what are the other international options? So we have something called advanced pricing arrangements. I'll speak on that. We also have mutual agreement procedure, and we have tax arbitration, which is the new kid on the block. And we'll go into that in detail. So what is an APA? Really, an APA is a prospective agreement, right, between a taxpayer and a tax authority, right? So the interesting thing about APAs is that you don't need to have an audit or a dispute. It's a taxpayer going to the revenue and saying, oh, I have this set of transactions, and I want us to agree on the transfer pricing method. I must mention, an APA usually arises where there are transfer pricing issues. So the taxpayer goes ahead of time to say, okay, I don't want us to fight down the road. Let's agree now on what prices I can price my goods. Let's agree on the pricing methods. Let's agree on all parameters, right? So when the tax day comes, we both know my tax liability and we both know my tax exposure. So it's forward-looking in nature. And the good thing about it, it removes every form of uncertainty. It puts the taxpayer in a place where they can say, oh, taxes are settled. I know my tax liability in year 5 from year 1. So usually APAs are negotiated on a 3 to 5 year basis. Unfortunately, we don't have APAs in Nigeria. Now, if you remember, if you would recall, if you would know, when the transfer pricing rules came out in 2012, there was a provision for APAs, so advanced pricing agreements. So at the point where they engaged taxpayers, sorry, we engaged FIRs to say, oh, we have a taxpayer who is interested in exploring APA. Can you sit down with us and let's discuss? And FIR says, no, sorry, we don't do APAs. But we say to them, but it's in the rules. Why don't you do APAs? Say, no, we don't want to bother with APAs. It's too technical. So at that point, we sense that FRS possibly then in 2012 was struggling with the technical bits, because with APAs, you need to make projections. You need to be sure that what you're signing up for, you're not going to resile at the end of the day. So it's really an agreement between taxpayers and tax authorities. Now, the interesting bit is it can be unilateral, bilateral, or multilateral. So what do I mean? It can be a taxpayer in Nigeria negotiating with a tax authority in Nigeria, FRS. It could be a taxpayer in Nigeria negotiating with a taxpayer, with tax authority in Nigeria and Ghana. So you have a situation where a taxpayer is negotiating with 2 tax authorities. It could also be multilateral, where a single taxpayer and 3 tax authorities of 3 different states or more. So it's that flexible. So the idea is, once you agree, it helps you sort of plan ahead. It helps you mitigate uncertainty, and you can know your tax liabilities in different jurisdictions from year 1 up to year 5. Now, the rules of contract apply because it's an agreement, really. So the APA is a full-blown agreement. You'll have provisions that the taxpayer would make commitments to, and if he checks those commitments, if he makes those commitments, if he complies with the commitments, then his tax treatment is certain. If he breaches it, then FRS can also come out of the agreement. So the interesting about the APA is it's flexible. You can use it in conjunction with other dispute resolution options, and it can be used as a standalone. Now, as I said, unfortunately, Nigeria does not do this now. It used to be in our old CP regulations, but fast forward to the more recent regulations, it was removed. And we suspect the reason is because it requires a lot of technical skills that FRS may not have developed at the point. But it's something we hope would come back. It's something we hope the FRS will build competence in and then start to use. Now, there's an interesting case if you want to do further, if you want to gain further knowledge on APAs, there's an interesting case you can read. It's called Eaton Corporation against IRS. So that's EATON Corp against IRS. It's an American case where the taxpayer had agreed to APAs with the IRS in America, and the IRS canceled it. And then the taxpayer went to court, and the court found that contractual principles applied such that the revenue, that's IRS, could not cancel if the taxpayer had met all his obligations under that contract. It's an interesting read, and it will throw more light on APAs. So how do you prepare APAs? As I said, it's a document. It's something that must be prepared along with taxpayers' transfer pricing policies. Now, whatever is in the document must flow with the substance. So it's a case where you must have your form, which is the contracting and substance in sync. It must be consistent with other intercompany transactions or contracts, and it must be applied consistently. People ask, okay, what if I agree in year 1 on how I'll be bound up to year 5? What happens if circumstances beyond my control change? What do I do? Does it automatically mean that I have breached my obligations under the APA? No, there are options. So once circumstances change, for example, you can go into an APA and agree the price of a commodity, like crude, for example. And because the price of crude fluctuates, you may get to year 2 or year 3, and the price has totally changed such that it affects your projections, it affects your obligations and your commitments. What do? All hope is not lost. You can simply approach FRS, ask and withdraw the previous APA and put forward a new APA. Or in the alternative, you can just amend. So it's real flexible where it works. The APA works very well in the UK. I know South Africa has a form of APA, and these things work. As I said earlier, we hope it's something FRS would pick up somewhere down the line. Now, the next interesting option is the mutual agreement procedure. So the mutual agreement procedure is the primary dispute resolution mechanism contained in double tax treaties. So if you are aware of double tax treaties, they are treaties between two countries where they sort of set the rules to prevent double taxation, right? So there's an article 25 in most treaties, or 24. The MAP really is a discussion between tax authorities of two different countries. And the aim is to resolve double taxation in most cases, or taxation that is not consistent with the treaty. Now, I said, let's not forget, it's really, the MAP is a conversation, right? There are discussions between tax authorities, which I've written here as competent authorities of two different countries. What this means really is that the taxpayer usually would not have any say. We don't have any, or will have minimal contribution to that process. The best taxpayers do under MAP is to come, present their cases. If the revenue authorities need any facts, taxpayer can provide those facts. But really, it's really a government-to-government discussion. E.g., if I was a business, say, I produce cement, I manufacture cement in Nigeria, but I have operations across Africa. If there's a case and between Nigeria, where I am, and other African countries, there are double tax treaties. If there's a dispute as to double taxation, the taxpayer can quickly initiate a MAP process. And what that process does is it sort of notifies the Federal Inland Revenue Service and the tax authority in other countries, and they now start to have a discussion. Again, the aim is to resolve on double taxation. So with the MAP, there are clear-cut rules, right, under the current bilateral double tax agreement. So typically, a taxpayer is expected to notify, for example, Nigeria, if he sees that there's a risk of double taxation, or he can also notify the revenue service in the other country in which it has operations. So the taxpayer has a choice. You can either notify your home country where you're resident, or the country where your source income comes from. So what typically happens when that notification is made is that the states in which the taxpayer is looks inward to see if it can resolve that potential double tax case unilaterally. And this would usually be by way of granting a credit or a deduction. If a tax authority can do that unilaterally, then there's no point escalating the MAP process. I must mention, most double tax treaties sets a rule, a time frame of 3 years. So a taxpayer must notify within a 3-year period. If it doesn't, then you'll potentially lose the option of an MAP. So I move to 2, where a tax authority tries to unilaterally resolve the conflict. If it cannot, then there's an obligation on that state to notify its counterparty in the other state. So again, a classic example. Let's assume I manufacture cement. I carry on business in Nigeria, France, everywhere. I fear that I'll be taxed in Nigeria on sales, and same profit to be taxed in France. What do? I go to Nigeria and say, oh, this is the problem I'm facing. Help me resolve it. So Nigeria looks into my problem. If they can fix it, then they fix it, and then the case goes. However, if they cannot, then FRS would contact the revenue service in France, right? And then the MAP process proper starts. So the engagement between the two tax authorities kick in. The rules are very interesting, right? So they say tax authorities should endeavor to resolve the dispute. Now, note the word endeavor there. Now, the word endeavor there has resulted in a lot of tax authorities claiming that there is no obligation on them to resolve disputes. So what happens is you have an unnecessarily long process of back and forth, because let's not forget, taxation goes really to the roots of sovereignty of all states. Every country is trying to protect its own tax base. A country will think, oh, if I move, if I shift, if I grant a concession, then I'll lose taxes, whereas the other country gains taxes. So by practice and by history, we see that under the MAP system, we had a lot of unresolved double tax cases because no state was really willing to shift. States didn't want to lose their tax base or tax revenues. And so a lot of taxpayers went in there and they were stuck. And the result was that many of them had to bear double taxation. Now, because of this, in 2015, sort of the rules, the OECD introduced new rules. One of those rules was a recommendation that an arbitration process should be introduced into the MAP. So you had a situation where if the two states could not resolve a problem, they would have to escalate to arbitration, then an arbitral panel will be set up, and there you have a binding dispute. Now that was very helpful because many taxpayers had their disputes resolved quickly and faster. Now, if you are interested in statistics, you can go to the OECD website. That's Organization for Economic Cooperation and Development. You see statistics before an arbitration process and statistics post the recommendation for arbitration. But we'll speak on that more lately. The third option for dispute resolution is arbitration. Now, this is the new kid on the block, as I said. And it arose primarily because of the failure of states to agree on treaty provisions. Basically, it grew out of the failures of the MAP, because the MAP, again, there was only a best endeavor, which states felt that did not give them any obligation to settle or to agree. There were lack of uniform set of rules that would guide the MAP discussions. So the rules were very detailed up until the discussions arose between the two tax authorities. The rules were very detailed. But once it got there, tax authorities could just, they would most likely treat it like a civil service issue, and sort of take the back foot on it. And there was no taxpayer involvement. So those were some of the shortfalls of the MAP procedure, which was what necessitated a recommendation by the OECD in 2015 under its base erosion and profit shifting project. So now what we have is we have a MAP process. As a complement to that MAP process, we now have arbitration. So the idea is that it's a more robust process. It gives the taxpayer the comfort that there will be a determined outcome via the arbitration process if the traditional MAP failed. So it's relatively new. Now in 2015, along with the recommendation for arbitration, the OECD introduced something called the MLI. So the MLI is a multilateral instrument. So what it does is that instrument, the intention of that instrument is to sort of unify all double tax treaties worldwide. So what states were supposed to do, were supposed to look at the MLI. MLI contained different provisions that were meant to update what we all agreed were outdated tax laws. So the MLI was a broad document, and states were supposed to opt in for arbitration. So if you're interested in arbitration, the state will opt in. So unfortunately, not all states have opted in. We have, I think my last count was probably maybe 40 states, but most G20 states, all the states in EU, one or two Western nations have opted in. Nigeria has stayed silent, and not surprising because of some of our domestic jurisprudence, but I'll speak on that subsequently. Now, with the arbitration, there are constitutional problems, and it's something I'll touch on as we go on. States need to agree as well on what procedural rules would guide the arbitration process, and Nigeria has not opted in. So what are the challenges with respect to tax arbitration in Nigeria? Now, we all know there's case law, and there's the constitutional provision of Section 251, which Jerome touched on briefly. So 251 tells us that no court except the federal court shall have jurisdiction. But then it begs the question again, is the TAT a court, or is the arbitration panel a court? So things like that. There are also case law, judgments of the Court of Appeal that the court specifically held that tax disputes are not subject to arbitration. I agree with those decisions to the extent that the tax in disputes in those cases are taxes that squarely fall under domestic taxes, such that there's no foreign government involved. It's just taxes in Nigeria. I disagree with that position to the extent that if there is a claim by another state on the same taxes, then you should open the courts or the government or the state should be open enough to allow arbitration so that the double tax dispute can be resolved. What's the other problem with arbitration? Problem with arbitration is that Nigeria has only 9 double tax treaties. So yes, we have map articles, map provisions under all of those. If Nigeria had signed up to arbitration, we would have possible 19 countries where we can arbitrate, or we can arbitrate with or against. We believe that is very, very low, considering the number of countries and considering the treaty network countries ideally should have. 19 is too low. What is another problem? Dispensation to APA and DPR. FRS has, as I said earlier, not really taking the bull by the horn to engage the APA process. And we don't blame them. It's probably a lack of the relevant skills, which I believe they will acquire as time goes on. DPR is the dispute resolution panel. It was also something that is contained in the current transfer pricing regulations, which allows the taxpayer to as a first point of call, even before going to TAT, to approach that dispute panel to say, okay, these are my issues. The tax authority has given me an objection, but these are the issues. When the DPR came up, I had 1 or 2 questions. I mean, there were questions of objectivity, because the panel there were supposed to be made up of directors of the FRS or deputy directors. But I know a client, right, who engaged DPR and was turned down because FRS was not willing to engage. So these 2 options are possible dispute resolution options that FRS has not engaged, but they are somewhere in our books, particularly DPR, which is in the current rules. And another challenge is no skilled personnel from FRS. What are the other options? We have mediation. We've seen increasingly many countries move to mediation. So mediation is not as rigid as, when I say rigid, I mean mediation, a mediator is appointed, right? And the role of the mediator is to facilitate discussions between taxpayer and tax authority. In the case where it's cross-border, a mediator would possibly facilitate discussion between the tax authority of 2 different countries. But usually from practice, we've seen it's usually applied domestically. So what a mediator will do typically is to look at the strengths of each case and weaknesses of each case, and then and provide that report where to say, these are your strengths, these are your weaknesses, these are your strengths and weaknesses for each party, then gives the parties the freedom to sort of reach an agreement. So the mediator, where it differs from arbitration, is that he only facilitates discussion between states. The final point I'll make is called factual determination. So this is something as well that pops up where there are cross-border or international tax disputes. And really it's basically to deal with issues of facts. And you have factual determinations usually where there are technical issues to deal with, as such that you need to call an expert witness. They are non-binding, they're just fact-finding exercises which taxpayers or tax authorities can resort to when they're trying to distill a particular set of facts that would help in applying substantive law. So in conclusion, what do we need to do? What do we need to note? We need to get to a place as a country where we have a broader network of double tax treaties. As a country, again, Nigeria needs to review its position with respect to tax arbitration and APAs. I say tax arbitration because once a tax matter becomes international, we can no longer conclude that the tax involved is this tax of the federal government. Another states, when I say state, I mean country, may also have legitimate claims over that same quantum of tax based on international trade and double tax treaties. So I think Nigeria needs to review its position on arbitration and advanced pricing agreements. Of course, we expect our tax administrators to develop the right set of skills. And even for us lawyers, the world is becoming smaller, right? Burning issues of taxation that are prevalent globally are also coming up in Nigeria. So we need to continue to update our skills, and because the discussions are usually the same. The same tax challenge you have in Nigeria, you probably have in Europe or in the States or everywhere in the world. And let's keep pace with global development. I tried to rush it. I hope I kept to time. Thank you very much. So I'm open to questions.
All right, thank you, Fola Jimmy. So we'll just quickly go into the questions because we have just about 25 minutes. So I will start from the question that started at 424 from Christopher. It says, how can you reconcile jurisdiction to hear matters on PIT under 78 PIT Act by state courts vis-a-vis the power of the TAT? Did you get that?
No, can you come again, please? So it says, how do you reconcile jurisdiction? Is that the question?
Yes.
So I think Jerome touched on that, and I think he's trying to speak. So Jerome said, and I agree with him. The TAT is there as a first point of call, right? Aside the TAT, you have a state high court that also has jurisdiction with respect to some parts of taxes that states can legislate on. With respect to the tax appeal tribunal, usually if the tax in question is a tax that it's a federal legislation, then I'll usually advise, let's go through the TAT route, go through the federal high court route. If it's a state taxes, I think state tax courts to an extent would have jurisdiction, particularly where the law is a law issued by the state. I hope I answered that. I think Jerome has something to add.
Okay. Coincidentally, I was just attending to that
okay,
question,
great. Yeah.
on the question and answer icon before it was brought up here.
Okay.
Okay. Okay. So
an interesting coincidence. Okay. So what I will say here now, since it has come up here, is that the provision of the Federal Inland Revenue Service Establishment Act, precisely Section 68(2), makes the, as I said during my presentation, makes the FIRS Act overriding supreme to the tax laws listed in the first schedule to the Act, which includes the Personal Income Tax Act. So we are talking about Section 78 of the Personal Income Tax Act here. So by virtue of that, Section 68, subsection 2 of FIRS Act, Section 59, that establishes the Tax Appeal Tribunal, and paragraph 20, sub 3 of the 5th schedule to FIRS Act that gives jurisdiction to the Tax Appeal Tribunal overrides Section 78 of the Personal Income Tax Act, to the effect that the jurisdiction of the Tax Appeal Tribunal is overriding to that of the State High Court in respect of resolving disputes that relate to revenue of state government. But as Fola Jimmy said, that does not erode doesn't erode the jurisdiction of state high courts when the dispute in question is not of any factual contention. If there is no controversy of fact in that dispute, then the parties can go to, or rather the aggrieved taxpayer can go to the High Court of that state and commence a suit by way of originating summons in order to address the issue of law raised. So to an extent, the jurisdiction of the State High Court is still preserved. But if there is this issue of fact in that dispute, I think the overriding effect of the FIRS at establishing the tribunal will now be invoked against Section 78 of the Personal Income Tax Act. Thank you very much.
okay, I think the next question would be, what is the place of the Revenue Court in light of the TAT?
The Revenue Court, I'm not aware of any other revenue court. The state government may establish revenue courts, but then the authority over the taxes, all the taxes now, which are listed in the first schedule to FIRS Act, is now conferred on the Tax Appeal Tribunal with the jurisdiction of the High Court. That's the High Court of the state, and the Federal High Court still reserved there. So this investment of the taxes go to the Tax Appeal Tribunal and the High Courts as provided for in the laws.
Yes, yes, Gerald.
I want to come in here.
To you. I've not appeared before Revenue Court, but I'll reckon that there are other taxes, maybe levies that are issued by states, and they are not creations of enactments that are peculiar to Lagos State or Edo State or one or two states. Maybe those ones you can have revenue courts as the forum to litigate, and that's my thinking.
Yes, you are right. Even the hotel tax that I mentioned, the jurisdiction cannot go to TAT because it's not one of the tax started listed in the schedule to the Federal Inland Revenue Establishment. So the revenue court handles taxes created by the State House of Assembly. Those taxes that Bidemi mentioned, like the local government taxes, tenement rate, and so on and so forth. So to that extent, the revenue court will handle those taxes. The federally enacted tax statutes as listed under the Federal Inland Revenue Act must be litigated at the tax appeal tribunal unless the issue you are raising has nothing to do with assessment. You know, you can actually go to federal high court in some cases, but in most cases, if it's based on assessment, dispute relating to tax, and so on and so forth, you have to go to tax appeal tribunal. Thank you.
Okay, now let me quickly add that. Yes.
Excuse me, can I comment briefly on this part? I find it very interesting, especially the point made by Jeremy. He referred to Section 68, sub 2 of the FIRS Act, and Section 59 of the same FIRS Act, which established the TAT. So the point is that, well, it is arguable. One, if you look at the whole thing, we know that appeals from TAT, civil appeals to TAT, goes to Federal High Court. There's no issue about that. There's also no issue as to whether or not TAT has the jurisdiction to administer those lists of taxes, virtually all those federal taxes. But again, of course, you know, at the beginning, when TAT was set up, there was controversy. There were conflicting decisions from the Federal High Court, the one in Lagos and the one in Abuja, which eventually it appears now to have been resolved by the Court of Appeal, which has decided that TAT is a mere administrative panel, that it is not a court, despite the use, despite all the judicial and quasi-judicial powers that the TAT exercises. And I heard, Jeremy, of course, you referred to some of the schedules. You know, the TAT has power to summon and all that. I've written an article on this, which actually I contended that in that paper that the powers of TAT, that the TAT with the FRS Act has not in any way cured the defects upon which the Court of Appeal struck down in Stablini v. Sonini, the case, the status of the V8 value-added tax tribunal. Now, if you look at Section 251 of the Constitution, it grants, especially Section 2511, grants exclusive original jurisdiction in certain matters to the Federal High Court. Okay?
Yeah. Not original.
I'm coming. Just allow me to learn. When it comes to tax, it's about the revenue of the federation or agency of the federal government. Though we know that Peter is a federal legislation, but the same Peter under Item 7 granted Item 7 of the concurrent legislative list or whatever, or you look at the Section 2 subsection 2 of the Peter, grants state tax authorities to collect taxes from those who reside there. Section 272 of the Constitution grants jurisdiction to state high court to entertain matters outside those ones that have been exclusively given to the given to the Federal High Court under Section 251 or 254C when it relates to national industry. Now, if you come to areas, it is established jurisprudentially, constitutionally, that any matter that resides, any residual matter, exclusively belongs to the state. Now, if, for instance, the state high court, in cases relating to individual taxes, personal income tax payable by individuals, that is not a revenue of the federation. That is not a revenue relating to the agency of the federation. I argue strongly that such cases could be handled by the State High Court. So it is an aberration. There's a problem.
So the problem is,
yes, Doctor, I totally
as a
agree with
federation.
you. See, the problem that Doctor raised, and we have raised the issue internally. If I file an
but
appeal
I was not there anyway.
relating to personal income tax at TAT, and then the provision is that the appeal goes from TAT to Federal High Court. Where do I appeal matters relating to
exactly? So that's the practical challenge. That's the practical challenge.
Why will I go to so there is a lacuna in the Federal Inland Revenue Establishment Act. Yes, we know the authority to enact law relating to personal income tax is that of the National Assembly. Yes.
So the reality is
that's just the problem. So how do I appeal such matter? Will I go to Federal High Court or State High Court for purpose of appeal? I mean, so there's a lacuna, and this needs to be corrected.
And you are right, Steve. I think the problem at the end of the day is for each state to have its own tax courts. Really.
Exactly.
That way you have your tax courts, appeals go to your state high courts, and from state you can go to Court of Appeal. It's just that we practice a fractured or an ill
unitary system. It's unitary.
Exactly. So if we had the real federation, we won't have these problems because each state will have its own court structure. One day we'll get there anyway, because I know some states are already clamoring for special tax courts for state taxes that has nothing to do with FIRS or federal legislation. So I guess it's for us to, as lawyers, to start making those calls and supporting those initiatives where states would have their own judicial bodies specific to tax matters relating to those states.
Yes, another problem to recall when you if you go to Personal Income Tax Act, you see that there is actually the provision under the Federal Inland Revenue System did not take care of power of the state to go to High Court to obtain a distraint order. So in essence, you still have some powers left to the State High Court. So, we can't operate in such a fragmented situation. Because, for instance, I have a case I'm handling for a client relating to setting aside a distraint order. Okay, we are challenging distraint order. They say, okay, why can't you go to Tax Appeal Tribunal and challenge the assessment? You are challenging, you can be challenging the distraint order at the state level and still go to Tax Appeal Tribunal at the same time. Somebody will raise the issue of abuse. Because in the first place, you have not set aside the distress order, which was initiated at the level of State High Court. So I think the work, the FIRS establishment is still not tidy. You have to tidy up these things. There should be arrangement. There should be a clear court where you can go to litigate all matters relating to personal income tax, and also a clear appeal procedure, because of course you cannot go to a Federal High Court on a state revenue matter. So there's a lot of there's lacuna in the law, and I think both the state and the federal revenue have to resolve this.
Can I say a word? Can I say just a word?
Okay, so while you're going to say a word, I think all the panelists will have 1 minute each to actually round up and also give us contribute your efforts to the unification, to unify all tax laws. So I'll start with Dr. Okoro, and then after that, Steve will go, and then Folajimi, and then Dr. Jude will round up, and then so that I can hand over to the ICLE chairman. Please go ahead. 1 minute, please.
Okay, thank you very much. The tax laws, they have made provisions, copious provisions on resolution of a dispute, but this piecemeal or the ununified provisions, conflicts between the laws is an issue that needs to be addressed, and much to be done now is about the interpretation by the courts. But as I was addressing one of the questions, what I wanted to say, even during my presentation, is that in spite of the Tax Appeal Tribunal, beyond the disputes that are just strictly statutory interpretation, even disputes that have issues of facts in it, I can go straight to the Federal High Court if it's about the revenue of the federal government. I can go to the State High Court and rely on Section 272 of the Constitution. I can rely on Section 251 of this Constitution. The only reason I won't do that is to avoid preliminary objection even if I'll succeed at the end of the day, I'd rather go to the tax appeal tribunal and save the time of my client, who is the taxpayer, in challenging that. But I know that I'm right and I will succeed if I do that. So as time goes on, the lacuna will be cured in the law. But before that is done, we as lawyers will do our best in writing articles to express our opinion, as Dr. Jude has done, contributed so richly to this controversy. And I believe as forums like this are organized, sessions like this are organized, and then articles are released, and then some of these things are tested by we who are specialized in tax, a time will come when these issues will be of history in resolution of tax disputes. So for a close, I say a big thanks to the Nigerian Bar Association for initiating this. I say thanks to my colleagues for the team spirit with which we made this a reality. Thank you very much.
Okay, can I come in?
Over to you. Yes, please.
Okay, I think to unify the tax laws, we have to go back to the constitution, because the constitution created a very big problem by, limiting the powers of the National Assembly regarding taxes. In the federal system, there's always problem of double taxation and imposition of tax by, different tiers of government. I mean, it should be something that should be resolved at the constitutional level by stipulating what each arm of government should be entitled to. I mean, yes, I understand that we are running a federal system, but we are also running a risk of, the citizens suffering from double and multiple taxation. So if you can handle that at the constitutional level, of course, the constitution is for the federation. And when we talk about the Nigerian Federation, we're talking about the federal government and the state government, and also the local government. So if at that level we can be able to, clearly spell out the taxes that each tier of government will be entitled to, I mean, it will make it easier. It will make the matter easier, especially at the level of local government, whereby they can just wake up with or without law and start, levying taxes and levy. There should be a constitution that clearly, itemize the taxes by each level of government. That will pretty much solve the problem of multiplicity of taxes. Well, at the level of personal income tax, we have the JTB that have been attempting to harmonize, personal income tax, but that is limited to personal income tax. It doesn't address the issue of levies. It doesn't address the issue of rates. It doesn't even adequately address the issues relating to VAT. So I think the constitution have to constitutional amendment should be able to address the issues.
Yeah, thank you, Steve. Yeah, and I'll stand on your shoulders if you permit me. When Dr. Jude started, he spoke about the autochthony of the Nigerian Constitution. So I think again, and Stephen, you've echoed those thoughts. That's where we need to start from. The problems we have arising from double taxation, e.g., consumption tax, VAT, all those issues are things that we should not have any problems with if we had the right kind of foundation in constitution. The second point is state tax cuts. I see no reason why, as a federation, each state should not boast of its own infrastructure that can handle disputes that relate specifically to its own revenue. I mean, and these are points, and these are things that we again, to echo you, Steve, we need a constitutional amendment to reflect the real character of our federation. Otherwise, then why bother calling us a federal republic? Thank you. And kudos to the federal government with the yearly tax amendments. I mean, BDB spoke well on this, on the omnibus bills, where we've had 2 iterations of Finance Acts. We hope this continues in subsequent regimes, because it's at these forums we can have opportunities on a yearly basis to speak up and identify issues that we think can be improved on going forward. Thank you very much.
So Dr. Jude, to you now.
Okay, thank you. Thank you, panelists and our attendees, participants, those who join us in this discussion. Well, my colleagues have actually pointed out the main problem to our tax regime. In particular, the Constitution appeared to be more unitary than federal, in terms of, even though there have been some partition of powers in the Constitution, but there are certain things that need not be in the exclusive legislative list, taking up everything, and in most federal states, for instance, in the United States, in Canada, you have federal and state taxes. You pay your federal tax, you pay your state taxes. You file to the different tax authorities in US. In Canada, there seems to be, especially within all the provinces and the Canada Revenue Authority, with the exception of Quebec, there's one particular agency you send it to the authority, and they'll be able to assess everything in once. So regardless of what happens, the point is that, again, the vestiges of military rule in Nigeria is causing a lot of problems. For instance, the Taxes and Levies and Privileges for Collection Act, which the Court of Appeal in your local government and Akwa Ibom actually struck down for being unconstitutional. This actually was a decree enacted by the military. Even though in my lectures, in my presentation, I said, well, if the court had looked at the legislative history of that very case, of that very statute, they wouldn't have struck everything down. So being saying that it is unconstitutional simply because the introductory part of it said not to stand in the provisions of the 1979 Constitution, that had been saved by the Section 315, the existing law clause. So the point is that in summary, let there be true federalism. Let there be true federalism. Federal government cannot hijack everything. The state should be able to have the power to impose taxes in certain areas, especially on those residual matters or matters within the concurrent legislative list. And they have their own judicial system so that each state could grow on its own. And that's the main problem we're seeing, and which we'll continue to fight for through federalism. True federalism is going to help Nigeria a lot. And I thank the Nigerian Bar Association for putting this together, which presents and gives us the opportunity to brainstorm over certain knotty issues in tax administration and practice. Thank you very much.
Thank you, everyone. So I'd like to say thank you to my panelists and then hand over to the chairman of the governing board of the ICLE, Mr. Tobin Narojikwe.
Good afternoon, panelists, delegates. You're all, I'm very grateful to all of us for having attended this session today. Particular thanks to the panelists for today and those who also, and Bidemi Olumide, who spoke yesterday. Dr. Judo Dinkodibo, my friend and brother, Steve Arubike, my good friend, Folajimi, great guy, and Dr. Jerome Okoro. Thank you very much for what I would say has been a very illuminating set of lectures. And I hope, I know how much work you guys have put in. It's a diverse array of practitioners, both Folajimi from PwC, Jude from Practice and Academia, Jerome and Steve and Bidemi from Private Practice Strictly. But it's been very illuminating. You all have shown that you are very good teachers. I wonder what, I can imagine how much the universities are losing by not having you lecturing. But thank you very much for a brilliant presentation today. I would just like to say to the delegates that we will send, as usual, the slides to all of you. I keep urging you and encouraging you to participate in these issues as we continue to strive to make continuing professional development a part of the body policy of the MBA. So thank you very much for attending, and God bless you all. Bye-bye.